authorized to declare recess of the committee at any time. This hearing is entitled Boom and Bust: Inequality, Home Ownership, and the Long-Term Impacts of the Hot Housing Market. I now recognize myself for 4 minutes to give an opening statement. As we celebrate National Home Ownership Month, we must recognize that home ownership is the primary driver of wealth for most families in the United States. It's a source of stability and opportunity for families who can leverage their home equity to put their kids through college, to start a business, and support them in retirement. However, not everyone has been able to realize the dream of home ownership, and the pandemic housing boom has made these disparities worse. In fact, while millions of people were able to take advantage of historically low interest rates to purchase homes or refinance their mortgages, skyrocketing home prices and other ongoing challenges made it harder for millennials and Gen Z, people of color, and individuals without intergenerational wealth to compete and access home ownership. So, while the Federal Reserve estimates that home equity reached a record $27.8 trillion by early 2022, many qualified would-be homebuyers could not partake in this wealth building event. These trends threaten to further widen the already wide racial, wealth, and home ownership gaps. Nationwide, Black borrowers are the only group to experience a decline in home purchase lending among borrowers of color. For example, in my city of Los Angeles, the Black home ownership rate was 34% in 2021. However, lower than it was in 1910. After experiencing a substantial loss of wealth during the post-2008 foreclosure crisis, households of color continue to be locked out of opportunities to build wealth. It's unconscionable that despite historical low interest rates, this nation was still unable to ensure that historically underserved and excluded borrowers could make home ownership gains. We have heard stories of Black homeowners being disproportionately denied refinance loans through appraisal bias and other kinds of discrimination, including reports that Wells Fargo denied nearly 50% of Black refinance applicants. We've heard stories of borrowers relying on mortgage financing being outcompeted by all cash buyers, including Wall Street backed investors and buyers. In a hearing chaired by Mr. Green yesterday, this committee heard about how these sales and conversions of homes into single-family rentals have harmed tenants, would-be homebuyers, and neighborhoods. So rising home prices are directly contributing to inflation, accounting for 40% of the price hikes in the last CPI score inflation numbers. And with recent interest rate hikes, we can expect that for many, the dream of home ownership will remain just that, a dream. Congress must pass this committee's housing title of the Build Back Better Act legislation I drafted that would create and preserve over 1 million homes. This $150 billion investment would ensure the long-term health of our economy by significantly increasing the supply of affordable housing, thereby reducing housing costs and corresponding inflationary pressures. Additionally, last week, committee Democrats passed my Down Payment Toward Equity Act to provide down payment and lending assistance to first-time, first-generation home buyers. I thank our witnesses and I yield back. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes.
Thank you, Madam Chair. Just last week, this committee marked up the chair's Down Payment Toward Equity Act, a massive $100 billion spending spree that would continue fueling skyrocketing housing costs. It's this kind of unchecked spending that is pushing the housing market from boom to bust for the average American family. That's on top of 40-year high inflation and skyrocketing consumer prices across the board, which are outpacing wage gains, in fact. This is clobbering household budgets. And if purchasing a home is still within the realm of possibility, that'll cost you double what it did just last year, from 3 to 6% now for a 30-year fixed rate mortgage. So let's break down that statistic. The median sales price for a house so far in this year, in 2022, is $428,700. With an FHA minimum allowable down payment of 3.5%, excluding closing costs and other fees, that means a first-time home buyer might have to finance as much as $413,700. At 6% interest, you're looking at a monthly payment of $2,480. That's up from $1,740 last year. So that's a $740 a month difference, or roughly a month's worth of groceries for a family of 4. And those groceries are more expensive this year, in fact. Potential home buyers are being pushed out of the market today. Instead of taking responsibility for this economic wreckage, President Biden is blaming anyone and anything other than his own policies. Earlier this month, he claimed there was, quote, zero evidence that the $2.66 trillion in new spending from his first 500 days in office had anything to do with inflation, that his spending had nothing to do with inflation. He even called that notion bizarre. And if you ask me, what's bizarre here is the cognitive dissonance between the Democrats' bad policies and their lack of accountability for this economic dumpster fire they've unleashed. We've been down this road before, and we know where it inevitably leads. It starts with Democrats creating new programs or pressuring the GSEs to make increasingly risky loans for borrowers who can't keep up with the artificial price spikes they've created. And it ends with those families, many low-income and first-time home buyers, being hurt the most when the housing market has a downturn. And taxpayers are left on the hook for tens of billions of dollars to boot. It doesn't have to be this way. We need to get serious about creating a sustainable housing finance system that can withstand the pressures of a market downturn. We should focus on ways to actually increase the supply of housing and create stable prices. And we should restore proper oversight of our housing finance regulators like FHFA and FHA, both of which have somehow gone more than 2 years without appearing before this committee. In fact, today's hearing would have been the perfect venue to hear from FHFA Director Thompson. Ranking Member Hill and I sent a letter last week urging the chair to invite Director Thompson to testify on growing threats to our housing finance system. It's those threats on which we should be focused. Instead, all we are getting today is more excuses, more pleas for new reckless government housing spending, and more empty promises than this time, and promises that this time it will be different. I yield back.
Thank you very much. I now recognize the chair of the Housing Community Development Insurance Subcommittee, the gentleman from Missouri, Mr. Cleaver, for 1 minute. Mr. Cleaver, you're on.
Thank you, Madam Chairwoman. Home ownership is the single largest source of wealth for the American family. Home ownership promotes wealth building by both acting as a forced saving mechanisms and by allowing families to benefit from the appreciation of their home value. Americans who own their homes have gained more than $6 trillion in housing wealth over the past 2 years. There are some Americans and institutional investors who have a remarkably positive story to tell about the housing boom during the pandemic. For other Americans and American communities, we are witnessing a gargantuan loss of wealth, which will leave a permanent impact on this nation. These Americans have lost their homes. They have seen the rising cost of housing eat away their incomes, and they have been delayed or they've been shut out the opportunity to build meaningful wealth in this nation. The impact of this troubling landscape will be substantial, particularly in communities of color. And I appreciate this hearing, Madam Chairwoman, and your razor-like focus on housing opportunities. Thank you, and I yield back.
Thank you very much. I now recognize the ranking member of the Housing Community Development Insurance Subcommittee, the gentleman from Arkansas, Mr. Hill, for 1 minute.
Thank you, Madam Chair. Thank you for holding today's hearing. I know every member of Congress shares the common view that we face a serious housing affordability challenge across our country, even though we may disagree on the best ways to address it. Madam Chair, do you remember the famous politician in New York, Jimmy McMillan? You might know him as the rent's too damn high party guy from governor of New York race back in 2010. Back then, a lot of people thought that campaign was a joke. But when the average home being sold this year is over $500,000, and last year 146 cities in the United States hit the mark where a typical house cost $1 million, people aren't laughing anymore. I look forward to hearing from today's witnesses about supply side solutions to our nation's affordability challenging, their outlook for the housing market amid these turbulent economic conditions and the Biden inflation. With that, Madam Chair, I thank the chair and I yield back.
Thank you very much, Mr. Hill. I want to welcome today's distinguished witnesses to the committee. First, we have Mr. Michel Calhoun, who is the president of the Center for Responsible Lending. Next, we have Professor Dr. Jung Hyun Choi, who is a senior research associate for the Housing Finance Policy Center at the Urban Institute. Next, we have Ms. Lydia Pope, who is the president of the National Association of Real Estate Brokers. And then we have Mr. Norbert Michel, who is the vice president and director of the Center for Monetary and Financial Alternatives in the Cato Institute. Without objection, your written statements will be made part of the record. You will have 5 minutes to summarize your testimony. You should be able to summarize your testimony in that time. Also, you should be able to see a timer that will indicate how much time you have left. I would ask you to be mindful of the timer so that we can be respectful of everyone's time. Mr. Calhoun, you are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, and members of the committee for the opportunity to testify on the critical housing issues impacting American families. In my testimony today, I'll first summarize the impact and lessons of the COVID pandemic and its impact on housing. Next, I'll set out the current affordability and supply challenges we face. And finally, I'll discuss the steps needed to make our housing system provide affordable, sustainable housing in the upcoming years for American families. As we all remember, 2020, COVID brought precipitous job losses and a grinding halt of much of our economy. There were prospects of double-digit foreclosures exceeding even those of the Great Recession, along with mass renter evictions and landlord insolvency. However, the comprehensive response of Congress and federal agencies was extraordinarily effective in preventing those calamities. Mortgage forbearance with payments deferred to the end of the loan maintained a strong housing market with low foreclosure rates and homeowners with sustainable mortgages. Likewise, the threatened wave of evictions of families that rent was largely averted through rental assistance that also sustained landlords. The overall economy recovered quickly with a return to low employment due to these interventions. That said, we are all aware that today we face formidable challenges. Recent increases in house prices and interest rates have combined to quickly produce a doubling of the monthly mortgage payment needed to buy a house. Rents have also escalated. As shown by the chart in my testimony setting out the history of housing booms and corrections in America, it will likely take a number of years for housing prices to normalize, usually through a flattening of house increases. Also, future stabilized interest rates will likely be higher than the record low rates of recent years. Combined, these will continue to reduce housing affordability. Housing production has also significantly trailed our needs for many years, and this shortage is a huge obstacle to families securing an affordable home. Another continuing challenge is that the growth of household wealth and home equity has been heavily skewed. Today, the top 1% hold 30% of the overall wealth, and the top 10% nearly 70%, while the lower half of American households have a total of only 2.6% of our nation's wealth. Housing gains have likewise been skewed, including a massive homeownership and wealth gap that is projected to continue to grow in the coming years. This gap is reflected in the fact that today, Black college graduates have less wealth and lower homeownership than white households that did not complete high school. In sum, there are pressing housing needs across the country, rural and urban. This calls for us to reform our housing policies and systems to better meet those needs, with the families today facing more volatility financially in today's 21st economy, and many households not having the personal or family wealth and the opportunities that provides. In my testimony, I detail a number of these specific policy reforms. First, we have to finish the COVID work of helping remaining families preserve their mortgages and their existing rental housing. It is far more effective to maintain housing security than to try to rebuild it. Second, we must aggressively expand housing supply, working at all levels of government and with multiple strategies. Next, with two 100-year crises hitting us in just a dozen years, we must harden our systems to withstand future systemic shocks. Equally important, the cost of addressing those shocks should be a collective burden and not placed on the most vulnerable families. In addition, we need well-structured supports that help families sustain the more frequent financial volatility occurring now. This includes deferral mods like we saw in the pandemic crisis, along with new programs like reserve funds and loss of income insurance programs. These efficient systems both help individual families and they lower the risk of our overall markets and institutions. Finally, we must recognize the scope of historic and ongoing discrimination documented in our housing market and the massive wealth and homeownership gap it has produced. Our future must include a commitment to the necessary effort and resources required to rectify this and provide housing security across the country for American families. Thank you, and I look forward to your questions.
Thank you. Next, we will go to Professor Chandan. You are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and distinguished members of the committee, thank you for the invitation to testify on the critically important issues of current housing market trends, the current housing market's historic decline in affordability, and policy options for supporting equitable access to homeownership. My name is Sam Chandan. I'm a professor of finance and director of the Center for Real Estate Finance Research at New York University's Stern School of Business. Home prices in the United States reached their last nadir in 2012 and have been rising rapidly in the decade since. Appreciation accelerated within months of the pandemic's taking hold, with home prices increasing at the fastest pace on record over the last 2 years. Today, the median price for existing homes stands above $400,000 for the first time. The 2020 inflection owes in large part to a shift in the location preferences of relatively mobile and affluent households favoring larger homes in lower density neighborhoods, and to other factors including demographic trends, low-cost financing, pandemic supplements to household income, and house price expectations. On their own, these demand drivers would not generate extraordinary house price increases. Rather, demand has coincided with a national housing supply shortage estimated at 3.8 million units by Freddie Mac and as high as 6.8 million units by the National Association of Realtors. The supply shortage is especially severe for entry-level homes. This is a long-term trend, not exclusively a feature of the current market. From approximately 40% in the early 1980s, the share of entry-level construction is now just 7% of homes under construction in the United States. Confounding longer-term supply and demand fundamentals, mortgage rates have surged in recent months. The impact of these increases has been immediate, resulting in a historic deterioration in measures of housing affordability. The combined impact of higher prices and mortgage rates and limited entry-level home construction is being felt disproportionately by families of color, younger families, and income-constrained families aspiring to home ownership. Today, these groups face even higher barriers to the nation's most reliable vehicle for generational wealth building, social and economic mobility, and housing-related health outcomes. Barriers to housing opportunity are wide-ranging and not only related to families' financial circumstances. Prevailing models of credit scoring, discrimination in the housing search process, higher financing costs unrelated to creditworthiness, and disparities in labor market and health outcomes during the pandemic are among the myriad headwinds. There are no interventions that will immediately and completely close the housing gap. Nonetheless, it is encouraging that in recent months, major initiatives have been announced that ameliorate the medium and long-term outlook, including elements of the administration's Housing Supply Action Plan. Fannie Mae and Freddie Mac's recently announced equitable housing finance plans seek to address many of the structural drivers of persistent disparities, including new approaches to the consideration of positive rental payment history. While the plans take important steps to improve access to financing, the enterprises are not tooled to address supply shortfalls directly. Whatever the mechanism, if the supply of affordable and workforce housing is not expanded, initiatives that enhance demand, however well-intentioned, will likely have the unintended consequence of undermining affordability for the very populations they are intended to support. So even as construction numbers rise in response to market forces, a multi-level approach to enhancing housing supply for all will address building code and zoning issues at the local level, supply shortfalls for construction materials and skilled labor, which may well be exacerbated in the coming years by infrastructure programs, improve access to financing for a wider range of housing types, including modular housing and smaller multifamily rental properties, and recognizing that investment in housing equity is also an investment in public health, with clear implications for both chronic and infectious disease morbidity and mortality. Additional demand-side policies might reduce local taxes and transaction costs of buying and selling, removing a barrier to mobility as households grow their families, thereby freeing up entry-level homes. As issues of supply loom large, the role of institutional investment in the housing market and its influence on prices has garnered increasing attention. Institutional buyers repositioning homes for the rental market represent a relatively new component of housing demand, responsive to families seeking the benefits of residing in a single-family home without the obligations or the benefits of outright ownership. Following the financial crisis, institutional investors likely had a small but favorable impact, supporting the stabilization of prices and housing occupancy in distressed neighborhoods. But the data also shows higher rent increases and rates of eviction facilitated by formal property management. The institutional investor share of the market has risen since just prior to the pandemic, but still only accounts for approximately 2.5% of home sales, according to Freddie Mac. On balance, the available data suggests that institutional investment and repositioning of homes for the rental market are not currently material contributors to national housing supply shortages. Thank you again for the opportunity to testify. I look forward to your questions.
Thank you very much. Next, we will go to Dr. Choi. You are now recognized for 5 minutes to present your oral testimony.
Madam Chair, Ranking Member McHenry, and members of the committee, thank you for the opportunity to testify today. I'd like to start by mentioning what I present today is based on my own views and should not be attributed to Urban Institute, its trustees, or funders. Today, I will share some key data points that highlight the racial disparities in homeownership that persisted prior to the pandemic, how the pandemic has disproportionately impacted households of color, and how the changes in the housing market environment are now again making it more difficult for households of color to access homeownership. Then I will mention 2 promising demand-side solutions that the federal government could consider that can benefit households of color to obtain and sustain homeownership. First, I would like to emphasize that large, persistent racial disparities in homeownership, one of the primary tools of building wealth, existed before the COVID-19 pandemic. Just before the pandemic, Black homeownership rate was 30 percentage points lower than the white homeownership rate. The Latino rate was about 24 percentage points lower, and the Asian rate was about 12 percentage points lower. the racial disparities exist even after controlling for income. Our research finds that unless well-designed intentional policies and actions are developed and executed, the racial homeownership gap, especially the Black-white gap, will remain unchanged in the next 20 years. Thanks to various efforts by the government to help households stay housed, including forbearance and emergency rental assistance, we have observed that both foreclosure and eviction rates fell below the pre-pandemic level. However, the data shows that both Black and Latino homeowners and renters were more likely to have missed their monthly housing payment amidst the pandemic. Additionally, following the Great Recession and now again during the COVID-19 pandemic, financial markets have tightened credit, restricting lending and making it difficult for households with less than perfect credit to buy homes. Credit history is the most cited reason for mortgage denial, having a disproportionate impact on Black and Latino borrowers who are more likely to have missing or low FICO scores. Tighter lending standards and disparities in credit scores mean that many Black and Latino renters who would have been able to obtain a mortgage under prior credit standards were more likely to face greater difficulties to access homeownership. As a result, these households missed the opportunity to build wealth from the rising home prices and benefit from the historically low interest rate in the past couple of years. Amidst the pandemic, both the home prices and rents have risen significantly. National home prices are now up more than 15% from a year ago, and rents have increased by more than 11%. The 30-year fixed mortgage rate is now around 6%, more than double the average rate last year. The limited housing supply has led to increased competition in the market. The share of cash buyers in recent months account for more than a third of all home purchases. Home buyers of color are more likely to purchase through FHA loans, but it has become more difficult for those using the FHA channel to compete with those with greater financial resources. Additionally, because of the spike in rental prices, those who remain renters will face greater difficulties saving up for future down payment. While multiple strategies are needed to bridge the racial homeownership gap, including the increase in the affordable housing supply, here I will mention two promising demand-side solutions that the federal government could consider. First is a better targeted down payment assistance. Our research finds that prioritizing first-generation home buyers can serve a greater share of households of color. For example, if we increase the income limits to 120% area median income and provide assistance to renters with parents who also rent, the share of potential Black and Latino households that the DPA program could serve is about 60%, compared to 46% of Black and Latino households under the 80% AMI criteria. The second is to incorporate rental payment into mortgage underwriting. Our research finds that past housing payment is a better predictor of future mortgage performance than credit scores. The GSEs have started to explore ways to include rental payment history in mortgage underwriting. While the GSEs are moving in the right direction, much more work is needed, such as incentivizing more landlords to report rental payment data to credit bureaus, standardizing the data, expanding the use of rental payment for underwriting at Fannie Mae and introducing it at Freddie Mac, FHA, and VA, and also providing guidelines to lenders on how to use this data in the mortgage underwriting process. Again, thank you for the opportunity to share my research with you today.
Thank you very much. Next, we will go to Ms. Pope. You are now recognized for 5 minutes to present your oral testimony.
Thank you. Honorable Chairwoman Waters, Ranking Members McHenry, members of the committee, thank you for the opportunity to speak to you today on behalf of the subject of homeownership, especially among Black Americans. My name is Lydia Pope. I'm the president of the National Association of Real Estate Brokers, known as NAREB. We are the largest and the oldest Black real estate trade association in America, and we are referred to as Realtors. Founded in 1947 with the mission of democracy in housing, NAREB was founded during a time of discriminative housing and lending policies that made it difficult for Blacks to own homes, of which many of these policies still exist today. NAREB members, through its 94 chapters across America, are on the front lines of the Black communities, creating housing opportunities, advocating for fair practice, and promoting policies that remove barriers to wealth creation. Today, increasing interest rate and home price markets is widening the wealth gap, delaying more and more Blacks from participating in the American dream. Today, Black homeownership is nearly 30% behind those of white America and lower than those 50 years ago. Today, COVID brought about some major shifts in the housing market. Today, we see investor cash buyers dominating the already no inventory market who purchases these properties to rent, raising the rental prices nationally. Today, if you're a Black person in America and you want to sell your home, you have to go through the unblack process in order to get a fair appraisal. Today, Blacks have been targeted by loan level pricing, down payment limitations, student loan qualifications, and outdated credit models accounting for race and credit scoring and underwriting. And today, there's a 1% increase in mortgage rates, decreasing the Black buying power by 11%. To this end, economic inequality has deepened and the housing rate has plummeted once again. Because of the national crisis and the effects of Black homeownership, NARAB since 2013 has published annually what we call our State of Housing in Black America report, known as SHIBA, which has become one of the most referenced and citing housing documents when discussing Black homeownership and offers some sound practical solutions. NARAB went a step further. In February 2022, we wrote our first white paper report called The Wire, which provides data that impacts the discriminatory practices against Black women. To close the wealth gap, NARAB is offering the final and following remedies that can impact and spur homeownership for Black Americans today, tomorrow, and generations to come. First, we fully support and urge the passage of the down payment assistance program that is part of the Build Back Better bill. Many Blacks fall into this first generation buyers and will greatly benefit from this fund. Secondly, NARAB supports the standardization to student loan calculations. The government policies encourages student loan deferment, then counts it as a negative in the FICO scoring for mortgage credit determination. This creates a large barrier to homeowners for many Blacks who would otherwise qualify. Third, NARAB calls for the elimination of loan level pricing adjustments in which lenders have been increasing the cost of financing to borrowers who are credit worthy and meet the program guidelines. Fourth, NARAB supports the PAVE task force and advocates for fair appraisals and understand diversity training must be broadened within the Appraisal Institute and violations must be vigorously dealt with. 5, NARAB supports the low balance mortgages and the secondary market for Blacks to buy these affordable units in communities that are predominantly minority. 6, NARAB supports the Equitable Housing Finance Plan that includes a special purpose credit program to address these inequalities in the housing finance system and extend the wealth building benefits of homeownership. And lastly, utilizing the services of the real estate professional are still needed in the home buying process. People need consumer protection, experience, knowledge, and the human touch to walk them through this already difficult process. And in closing, I would say this is a tough time, and NARAB applauds this committee's efforts in this area. I'm a resident of Cleveland, Ohio, and my past experience as a single Black woman with 2 children is why my mission and passion on equality and equity is so important. I was that victim of predatory lending, and I was that woman taken advantage of in the real estate market because no one held my hand to buy a home. My solution: to get a real estate license and stand before you as the national president to make a difference. I employ the committees, the legislators, the administrative officials, the GSEs, the housing regulators, and directors to join NARAB in promoting and ensuring democracy in housing. Thank you.
Thank you very much. Next, we will go to Mr. Michel. You are now recognized for 5 minutes to present your oral testimony.
Good afternoon, Chairwoman Waters, Ranking Member McHenry, members of the committee. Thank you for the opportunity to testify today. My name is Norbert Michel. I'm Vice President and Director for the Center for Monetary and Financial Alternatives at the Cato Institute. The views that I express today are my own. They should not be construed as representing any official position of the Cato Institute. Today, I argue that the best way for the federal government to make housing more affordable is to reverse course on federal policies that increase demand. It is true that home equity frequently represents a large portion of many Americans' wealth, but it does not follow that federal policy should promote housing debt. In fact, home equity depends largely on home price appreciation, an attribute fundamentally in conflict with more affordable housing. And federal policies undoubtedly make housing, as well as other goods and services, less affordable. And they do so because they artificially boost demand in supply-constrained markets. And from 2012 to 2021, home price growth rate was nearly double the income growth rate. There are at least three glaring problems with these recent federal policies. First, the level of federal involvement in housing has been escalating for decades. Along with housing cost, that correlation is no accident. Combined, Fannie and Freddie have stood behind more than half of outstanding mortgage debt for decades, and in some years responsible for a share of close to 70%. From 2009 to 2020, Fannie and Freddie's annual share of the total mortgage-backed security market averaged 70%. If we include Ginnie Mae securities, the federal share of the MBS market averaged 92% per year over this period. Virtually all federal housing policies, even those outside the GSEs and FHA, are geared toward increasing demand. But because housing markets are almost always supply constrained, these policies consistently put upward pressure on prices and rents. These policies include everything from supporting the GSEs to providing housing allowances to military and other government employees, as well as basic Section 8 vouchers. The economic principles are the same. They place upward pressure on prices because they increase the number of dollars chasing the same amount of housing. And there is surely some spillover to related markets. Second, wasteful spending since 2020 has only worsened the effects of these demand-inducing housing policies. Congress passed 5 massive spending bills starting in November of 2021, totaling $7.5 trillion. This spending spree worsened inflation and exacerbated both labor market problems and pandemic-related supply chain problems, thus leading to the abnormally high increases in the CPI that Americans continue to experience. Total spending, a demand-side measure, bounced back sharply starting in the second quarter of 2020 and kept rising through the third quarter of 2021. Starting with April of 2021, virtually every monthly CPI report has indicated some form of abnormally high inflation. In May, the year-over-year CPI rose at an annual rate of 8.6%, the largest 12-month increase since 1981. It was a broad-based increase, with prices for shelter, gas, and food being the largest contributors. Yet Congress and the administration seemed content with that failed approach of increased federal spending. The problem is that federal spending, whether it's on a museum, Section 8, or infrastructure, boosts demand while doing nothing to address supply constraints, or leads to more inflation while doing nothing to address the underlying issues that create the inflation in the first place. Finally, the Federal Reserve has contributed to higher housing costs by continuing to support the MBS market and therefore fueling more leverage to buy homes in a low interest rate environment. Prior to the 2008 crisis, the Fed rarely held any MBS on its balance sheet, but now it acts as though it can't operate without holding massive quantities of GSE-issued mortgage-backed securities. Between 2010 and 2022, the lowest amount held was $827 billion. And the Fed went from holding $1.4 trillion in 2020 to $2.7 trillion in 2022. In the face of a rapidly rising CPI and steadily rising home prices, this MBS purchase policy makes very little sense. Thank you for your consideration, and I'll be happy to answer any questions you may have.
Thank you very much. I now recognize 5 minutes for questions. Ms. Pope, first of all, I want to thank you for being here and the work that the realtors have been doing ever since I've been elected to office to deal with discrimination and other issues dealing with home ownership. During the pandemic, increased competition for homes in a tight housing market pushed home ownership further out of reach for many prospective first-time buyers, people of color, and low-wealth individuals. A recent study by the National Association of Real Estate Brokers showed that in 2021, the racial home ownership gap grew to over 30%, higher than it was in 1960. In my city of Los Angeles, the Black home ownership rate was 34% in 2021, lower than it was in 1910. Last week, our Democratic committee passed my down payment toward Equity Act. My bill would authorize $100 billion for a new grant program to provide assistance of up to 10% of the purchase price of a home to first-time, first-generation home buyers to help cover down payments, closing costs, and to help buy down interest rates. What do you see as the potential impacts of such a program?
The impact, and thank you, Congresswoman Waters, the impact will be greatly impacting in the Black community, especially knowing that down payment is one of the largest factors of not just systematic racism that we've encountered over the country and over the years, but this will be a big help when it comes to generational wealth. So that's extremely a very good opportunity for Black Americans to take advantage of, and again, allow the creation of the generational wealth to continue. And then it will help mediate the actions of the inequalities, the wealth gap, and the discriminatory practices. This will be a great help to the Black American families.
Thank you very much. Even though I had not planned on asking this question, I am very interested in knowing what is happening with the evaluation, basically, of homes in the Black community, and what is happening with the way that the discrimination appears to be taking place for so many years.
As you know, over the sake of the country, all the values have diminished. They've lowered the values because of the appraisals. And we as NARAB is working very closely, our affiliate as well, and we're very supporting of the PAVE Act in order to stop the discrimination of the appraisals and the biases. We're hoping that we'll have more training so that this will more training of the appraisals and more licensed appraisers to be able to do what they need to do in order to bring the economy back and to allow our Black homeowners to be able to sell their properties and to buy properties not at those low values. So we're taking a stand and supporting the PAVE.
Thank you so very much. Professor Chandan, house prices have skyrocketed during the pandemic, appreciating nationally by nearly 20% between 2021 and 2022, making home buyers that much unaffordable. In fact, according to the California Association of Realtors, only 25% of Californians could afford to purchase a medium-priced home in the first quarter of 2022, compared to 47% of home buyers nationally. One driver of this affordability crisis is the worsening housing supply shortage. Last year, the House passed the Build Back Better Act, which included over $150 billion in investments that would create and preserve over 1.3 million homes, including by offering incentives to local jurisdictions to ease burdens to buying new and building new housing. Can you talk about the importance of making the types of transformative housing and community development investments included in the Build Back Better Act?
Thank you, Chairwoman Waters. I think what we do see, as you've alluded to, is that we have a significant challenge in terms of the supply and availability of new homes. That number has risen significantly over the course of the last year and a half or so, and we have a substantial pipeline of homes under construction. But to your point, when we look at the mix of what is being built in the United States today, in part because of local zoning requirements, building codes, restrictions on the availability of land, the cost of materials, only a very, very small share of those homes is within reach of income-constrained families and many aspirational home buyers. And so programs that not only encourage supply, but encourage supply that is specifically directed towards income-constrained families and those who are aspiring to home ownership will be most effective in alleviating some of the supply challenges and pricing issues that we face.
Thank you very much. Mr. McHenry, the gentleman from North Carolina, who is the ranking member of the committee, is now recognized for 5 minutes.
Thank you, Madam Chair. Dr. Michel, I want to drill a little bit deeper into today's hearing title. It's called Boom or Bust. And look, as I outlined in my opening statement, in President Biden's first 500 days in office, he increased federal spending by more than $2.5 trillion. Our national debt now surpasses $30 trillion. The massive spending spree includes nearly $2 trillion in the so-called American Rescue Plan, the $256 billion Infrastructure Investment and Jobs Act, enacted last year. It doesn't include the $1.7 trillion so-called Build Back Better, or whatever they're calling it right now. I know it keeps changing week over week, but that bill that passed the House in November, that was then called Build Back Better. It also doesn't include a trio of housing bills that the chair has introduced, but have not passed the House. That includes $600 billion in housing and Housing is Infrastructure, or her unscored Ending Homelessness Act that is likely to cost nearly $200 billion a year. Her $100 billion down payment toward Equity Act. Those are nearly $1 trillion in new spending, all from borrowed money. So if you would, please explain both the observed and projected effects that this massive spending is having on the economy, and the connection to the record inflation Americans are experiencing.
Sure. So the stimulus was more than triple, depending on exactly how you cut it, but more than triple the gap between actual output in the economy and what we estimate as the potential output of the economy. Even before March of 2022, the $1.5 trillion spending package that we had back then, federal spending had increased people's quarterly disposable income, even on a per capita basis, by incredibly abnormal rates, like things like 14% in the first quarter of 2021. That's well over the average quarterly increase, which is less than 1% during the last decade. So there's pretty much no way that that sort of spending won't eventually lead to inflation. The result that we've got now is really not all that surprising. It's just an enormous amount of money relative to what people are used to having on the whole. And now this is worse, of course, for anyone on fixed income or without a steady or secure or indexed to inflation source of long-term income, because they are not getting that money directly or indirectly at first. They are getting the price increases first in many cases. And then in many cases, when they've already got some of the income, they're still getting an even larger price increase now. Again, I think that's due to the magnitude. So this is bad for millions of people. And I think it's probably obvious that to most people that the lower your income and the more volatile your income, the worse your situation, the harder this is going to be to deal with. So that's kind of where I would go with that.
So we know that federal spending comes in a lot of forms, but one of the worst is when we come up with new giveaway subsidies for people who probably don't need it and shouldn't get it. One good example is a provision in that Build Back Better bill that the House passed in November. We marked up that same provision again last week. This provision would create a new first-generation down payment fund to give down payment grants up to $20,000 or 10% of the purchase price of a home. Individuals making up to 140% of the median income of the area would be eligible to get these grants if they didn't own a home in the last 3 years, and the parents currently didn't own a home. So this means an individual in Marin County, California, making up to $232,000 could qualify for more than $97,000 in free government money on a $970,000 home, even if they had owned the same size home 1,000 days earlier. So, as an economist, what sort of what does a subsidy like that do to the marketplace? And what are how do you respond to such an irrational demand side subsidy when no subsidy is even required in the first place?
Yeah, I mean, this makes no sense at all. It's a terrible policy. The response will be even higher home prices. It's only a question of how long it will take and how much upward pressure you're going to get. Very soon, I would expect sellers to know that the first 100,000 or so is taken care of, so you can charge more. It's similar to the effect that dropping the interest rate has on a monthly payment. It's going to get capitalized into the price of the home. So if you do that, you're going to get price inflation in the home and or price increases in the homes. And if that 100 billion or that program doesn't get renewed, you would expect prices to flatten out and eventually drop. And then anyone coming into the market late or with lower equity who's already in is at a very high risk for being underwater. So I mean, it makes no sense at all in any way.
Thank you very much. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Thank you. A few comments. First, it's interesting. We're all in favor of appreciation. We're all in favor of affordability. Those are contradictory. There's an irony there, but there's reason for us to support both. Our committee naturally focuses on financing of housing, but we've got to look at other governmental entities and what they're doing to the affordability of housing. Our friends over at the Ways and Means Committee have taken away the deduction for property taxes for an awful lot of taxpayers, and they have not indexed that provision for inflation. So whether it's 2% inflation or whether it's a much higher level of inflation, that provision hurts not only the upper middle class, but will soon hit the middle class. The same applies to their limitation on home mortgage deductions. So while we're making housing more available, they're making housing more costly. But the biggest impact is local government. The NIMBYs really control housing. And in so many areas, people want either open space or maybe open space dotted by a few rich houses. The effect is that the cost of providing a new structure, and we need at least 5 million more of them, is double or triple what it would be. The physical cost of building the home isn't the cost. The cost is dealing with the zoning, the resulting increase in land prices, the fees, and all the requirements that are often designed to make sure that communities are not economically integrated. And of course, that means in many cases not racially integrated. I realize we're focused on home ownership. Not everyone should buy a home. If you're not going to live there, you're not sure you're going to live there for at least 6 years, it's not in your interest usually to buy a home. And there ought to be single family homes that are available for rent. I believe one witness said 2.5% of the homes are owned by institutions that rent them out, and that seems reasonable. We have a labor market where people are willing to move around far more than they are in Europe, and that gives us an economic advantage. Our witness from the Cato Institute points out that government spending increases demand and inflation. What he did not point out is that taxes reduce demand and reduce inflation, and that's why BBB was fully paid for, and why if we can tax the wealthy appropriately, we can reduce inflation. Mr. Calhoun, we often hear that FHA borrowers struggle to compete against those who are borrowing with a conventional mortgage. This is explained because sellers want to avoid the longer closing times, the tougher appraisal requirements. Last year, the House passed my bill, which unfortunately we did not have a unicameral legislature, so it died in the Senate, the Home Buyers Assistance Act, which broadens the types of appraisers that can appraise for an FHA purchase to be the same as those that can do it for do the appraisals for the GSEs. This is significant because FHA borrowers are overwhelmingly first-time home buyers and disproportionately people of color. Are there other policies that we can take, whether it's the appraisal requirements or elsewhere, so that FHA borrowers are on an equal footing when they go to buy a house?
Yes, Congressman, if I could first add one comment to your last comments. I think it's important, included in my chart, in my testimony was a chart that I will just show you here, is the history of housing prices. The colored part is real dollars.
I'll ask you to focus on the question. We got 40 seconds.
Okay. Yes, there are things that you can do. Your appraisal thing, the current requirement of certified appraisers makes it much harder to find an appraiser and creates more delays. That's one of the most important things. FHA is doing a number of other things, increasing their technological services so they move faster. And then right now they have several proposals that provide more clarity for lenders to make it easier for borrowers to qualify and to encourage lenders to participate in the FHA program. As you know, FHA is the largest provider of new home purchases for borrowers of color.
I just want to point out how important it is to pass the Chairwoman's down payment assistance program.
Indeed.
Half the millennial home buyers needed family to help them, and not everybody's got a rich uncle or a helpful parent. I yield back.
Thank you very much. The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. And today marks the 20th housing hearing this committee has held in the 117th Congress. And yet it seems we are not any closer to bringing down the high cost of housing. Over the course of 20 hearings, instead of addressing the lack of production of new housing units, the majority has spread blame on property owners, investors, appraisal firms, and the mortgage industry. More Biden blame game. Meanwhile, the Biden administration and Democrats in Congress have recklessly spent trillions in taxpayer money that has worsened inflation, crippled supply chain and construction markets, and ultimately made housing even less affordable. Dr. Michel, I represent the 2nd Congressional District of Missouri, which continues to experience labor shortages and supply chain issues that affect almost every industry, from construction to manufacturing. Collectively, do the policies offered today by the majority and the Biden administration address those issues?
No, it would worsen it. This is, the idea. It's maybe, I'm sure it's well intentioned. You want to help people. Everybody wants to help other people, and that's good. But the fact remains that if you go down this road of giving just giving out more money, it still takes a long time to build a house. You can't build a house in every single location where people want to live. There's not enough land. You don't have enough laborers to do everything that you want to do. You have an infrastructure package that's going to draw laborers to that. So you're going to be throwing more money, allowing people to bid up the same amount of resources over a short period of time. And that's the opposite of what you want to do if you want to make things more affordable and easier to obtain.
Could you describe how the supply chain issues we are facing will continue to drive up home prices and rental rates if left unaddressed?
Yeah, no, it would be the same sort of situation where you don't have enough of what you want and you don't have a way to get everything quickly. If you talk about things like livestock or labor, you can't magically produce them no matter how much you want to bid up the price. So letting these things go, letting these supply and demand forces sort of take hold without further subsidizing them is the only way to let those prices come back down, to let the market reallocate on its own pace, rather than trying to just continue to increase the demand side.
Yeah, the federal role in housing finance policies has expanded greatly over the last several decades, and yet the American homeownership rate remains at roughly the same level as the 1960s. Dr. Michel, is there evidence that would suggest the entrenched role of the federal government in the housing market has played a role in its current state?
Yeah, absolutely. It's kind of amazing to hear lots of the other people on the panel suggesting that we just continue doing the same thing that we've been doing that got us in this place, into this mess in the first place. The only appreciable increase in, for example, the Black or Latin home ownership rate was prior to the last crisis, and that was not sustainable by definition. We want to keep helping people. That's good. That doesn't mean that you help people by giving them low equity, long-term fixed loans that they can't afford. And if you have a volatile source of income, for example, you're not addressing the underlying economic issues. You're just throwing money at a problem and you're putting somebody in a financially risky category. So the fact that you take some of that stimulus away or some of that subsidization away, and that it's not sustainable, it ends in a bust.
And Dr. Michel, in my short time, I know your testimony outlines many harmful housing policies that the Democrats have been pushing in their Build Back Better or Broke plan, whatever you want to call it. While the list is quite long, could you briefly mention some of the most harmful policies?
Well, you're outside of the GSEs, is that?
Yes.
I mean, I think if you look at the GSEs, just that's the biggest chunk of it for me. The GSEs and the FHA. This is no longer a small program. This is the entire market. So it's essentially a federal takeover. And with those expansions, we've seen this happen over and time again.
Yeah, thank you. I yield back the balance of.
Thank you, and thank you so much, Ms. Wagner, for recognizing that we've made priority housing with 20 hearings and no help from Republicans. Thank you very, very much. The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. And I just got to just real quickly, because I heard Representative Wagner and Representative Henry, they keep talking about, it seems to me that some of the housing crisis, particularly with regard to in Black America, predates all of what they are talking about. But it also seems to me that when you help someone, give them a hand up, it's okay. But when you have the huge Republican tax cuts that goes to the wealthiest of Americans, that is much more money than you see going to regular folks, that's okay. And then to say that the president is not doing the right things when, in fact, we know that we're coming out of the greatest pandemic that this country has seen in over 100 years. And yes, the war in Ukraine is affecting the economies, which is why the president is at the G7 and at NATO now, working together with our allies who are also suffering from inflation and suffering from Putin's war. So there's no question about that. And I would hope that my Republican colleagues who say that they're supporting Ukraine, which we all should do, and make sure that they get the money that they need to defend themselves, but we should also support our people at home. And we had a conversation with Chairman Powell, who said that if we did not make the investments that we made during the pandemic, that our economy would not be as strong as it is right now, which is stronger than many other places or most other places around the world. So I just had to get that in because, to say that we are supporting Ukraine, but then say, oh, the president is making it up when you know and can see the comparison just does not make sense. So if you're not going to support Ukraine, then say you're not supporting Ukraine, because that does cause us to have higher gas prices and inflation in the United States of America. But now let me go to my question to Ms. Pope first. Ms. Pope, I know your great organization has put out a report, and I think that the chairwoman started talking about this earlier, about the state of housing in Black America, which discusses other challenges that's confronted by Black homeowners, including the home appraisal practices, where the loans, already we know more costly for Black households. And on top of that, the Black homes tend to appreciate less or be valued at a lower value. So this whole thing in regards to algorithms, that may be, can you explain what role of AVMs are and what more needs to be done to make sure that calculations and algorithms aren't having inadvertent negative consequences, or what should we be doing to make sure that we have equity there?
Thank you, Congressman Meeks. When it comes to the Black neighborhood and the appraisals, you're absolutely correct. The housing market is diminishing, the appraisal values are low. And then what are we doing, not just as a national association, but as America? It's important that when we're dealing with the appraisers and the appraisal society, that number one, 1% of the appraisal society are Black. We don't have enough African Americans within the industry to understand the values of our neighborhoods, where we grew up at, where we know about, where we know the house across the street is worth more value than what the appraiser has stated. So the importance of even the PAVE PAVE Act, to discuss a lot of the challenges on the training that needs to happen within the appraisal society, the licenses that needs to take place. In addition to that, we need to make sure that we hire and employ more Black appraisers so that they can have an opportunity, lessen some of the guidelines for the appraisers to be able to increase that community so that we're able to have true, in fact, real appraisers. When it comes to systematic racism, the low access to capital, to healthcare, the quality of food, the inequality and the racial discrimination has happened over 400 years ago. It hasn't changed. And as we're seeing now, it's just being bought out. So it's so important that we, as an organization and as America, need to make a difference in the appraisal society. And we've got to hire and employ more Black appraisers.
Thank you for that. And in my little time, I'm going to go to Ms. Choi just to ask, what role does student loan debt play in serving as a barrier to home ownership? And how can we address this issue here in Congress? I put a bill out called Home Ownership for Borrowers with Student Debt Act. And I know for me, coming out of college with student loans, that was it prohibited me from owning a home for a while. So can you address that, Ms. Chow?
Yes, thank you for the question. I think this is a very important topic. I think student loan debt has the same issue with the access to home ownership, because a lot of wealthy young adults who have wealthy parents get access to education without student debt. But we are seeing from the data, a lot of Black young adults are having a higher student debt for the same level of education. They're more likely to drop out of college because they have multiple duties to serve. And also, even after they graduate, they run into problems of being delinquent in that home. And that is also having a negative impact on the access to home ownership. So I would love to look more into your text, but I think this is a very, very important issue to address.
Thank you very much. I'm out of time. Thank you, Madam Chair. You're back.
Mr. Posey, you're now recognized for 5 minutes.
Thank you, Chairwoman Waters. Mr. Michel, the opening lines of the majority policy paper for this hearing suggests homeownership should be a policy tool for closing a wealth gap in this country. Please tell us what economic research suggests about making reduced wealth gap an objective for homeownership policy.
Well, I don't agree that it should be that home ownership itself should be a policy. There are lots of reasons not to own a home. It's an individual decision, and if we're talking about something like sustainable home ownership, there are many economic conditions and reasons that will make that either difficult or easy. There's nothing wrong with renting. Federal policy should not distinguish between both or between either renting or owning. The research does not, even though there's a correlation between things like, say, good citizenship and homeownership, it doesn't mean that one causes the other. There's actually lots of research that shows negative spillover effects from owning, especially low equity, long-term low equity loans. Negative spillovers like hesitancy to move in search of a better job opportunity, just to name one off the top of my head. Is that where you're going? I'm not sure if I'm answering exactly what you're.
You're answering exactly. I just was looking for some balance, and you provide that balance. And so thank you for being so straightforward with that.
Okay.
When Secretary Carson was the HUD, we had begun to appreciate that making housing affordable depends a lot on being able to expand new housing supply while holding the line best way possible of building new housing. What happens to housing prices and affordability when we expand housing demand subsidies without addressing the conditions of housing supply?
Prices go up, and as the prices go up with the FH through either FHA or GSE loans that we have more lower equity loans. So you've got sort of pockets geographically throughout the United States that are either more or less constrained than others. And then you've basically got one federal policy that just says, give more loans, get more loans. So it's not surprising to get exactly the result that we've had, which is more consumer debt and incredibly rapid increasing home prices.
What do you think Congress should do to help bring down the cost of building new housing so that we can expand supply to meet the growing demand without driving up prices?
Well, there's very little that Congress can do to increase the supply. So what it has to do is concern itself with demand relative to supply. And that again means paring back on the increase in demand. So supply is going to be more local driven, and you have to back off, literally back off. You have to shrink the footprint of all the things that are being done federally to increase demand. Otherwise, you're going to keep getting higher prices.
One of the bills under consideration in this hearing is the bill to provide 20 to 25,000 or even more in high-cost areas to provide qualifying assistance to certain first-generation home buyers in purchasing their first home. Can you comment on the pros and cons of that approach?
Well, the pros, of course, are if you do get if you're a recipient of that, you get the money for your down payment, and that's good for you. But the cons to that, again, are you're doing nothing to change the underlying conditions. So if you have a African American, for example, that doesn't have a rich uncle, you're assuming that simply giving them the money would be good for them. And again, while it might be good to be able to purchase that home, you're actually not purchasing a home, you're purchasing a mortgage. And the research shows that what we get from spillovers from home ownership, you could actually be picking up the behaviors that somebody has or builds over time when they do save money. So you're taking the saving the money part out of the equation. You're saying that that doesn't matter, when in fact the research shows that that part could matter more. And that's not to say that there shouldn't be something done to advance and increase economic opportunity, but there's a difference between that and just giving somebody the check.
Gotcha. Listen, for the record, Madam Chair, I've been a realtor for well over 40 years, and I can assure you, during the entire time since the very beginning, first orientation class, every realtor is aware that there should not be any discrimination in housing whatsoever, and the only color any realtor should be concerned with is green, and that's putting the deal together. Thank you. I yield back.
Thank you very much. The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agricultural Committee, is now recognized for 5 minutes.
Thank you, Chair Lady. Mr. Pope, let me direct this question to you. A recent study pointed out that 33% of home sales were made by private investment groups in my area. And my area in Atlanta led the nation as the #1 metropolitan area in the entire nation for investor purchases of single-family homes. And so, Ms. Pope, explain how this investor activity in this subset of housing markets impacts individual buyers and hurts us. Ms. Pope.
Thank you. Thank you, Councilman Scott. First of all, when lenders hesitate in a low balance mortgage in an area, buyers can't purchase. So when they can't purchase, a lot of times it opens the doors for investors who pays cash. Also, these cash investors, they do them in bulk. So the more properties for less money, it's a wholesale. What happens in this case, it displaces the residents, which creates low inventory, and it creates definitely low inventory for the neighborhood. But what ends up happening is you have a high rental market that makes it not sustainable for the home ownership. And it makes it difficult for anyone looking to buy a property that this is hard to buy because all the property's been taken up by these type of investors who are buying them and paying in cash. Our typical home buyer doesn't have the cash. They just don't have it. That's why financing is available. So to strip that away from the American dream strips them away from that home ownership.
Yeah, and to your point, the Atlanta Journal-Constitution, our home newspaper, reported that this large investor buying activity was linked to a drastic decline in home ownership rates. And however, develops, as the case in so many often situations, this connection disappeared when comparing predominantly white neighborhoods with predominantly Black neighborhoods. Ms. Pope, explain that for me.
And I hope I'm explaining this correctly. So when an investor buys a single property, rather they're going to rent it or fix it up to sell, then that market is increased. It makes the inventory low, first of all, because that borrower can't purchase it at prime price. Now it's excelled because that investor fixed the property up and resold it and flipped it. That makes it very difficult in a community because then it becomes unaffordable and possibly having challenges with the appraisals. And that's what we're finding across the board. I'm from Ohio, and we follow the same issues of having all of these investors buying in neighborhoods, increasing the sales price or renting. Everything's escalated higher. And then it makes it harder for a Black person or anyone to buy a home in that area because of the appraisal values or because they can't afford it now. It's not the typical average regular price.
And let me get to the genesis of the issue from my standpoint. How are these firms able to track what neighborhoods and areas will see future high-paying jobs and good performing schools, which tend to increase home prices?
So when an investor buys a property, it strips away the home ownership. So you're right, the home buyers, the school systems that they go, the grocery stores they go to, the banks that are very little in the neighborhood becomes a challenge because now you're taking away that home ownership, that neighborhood that is created to have sustainability. So that's stripped away when you're lessening the housing market and increasing the rental market.
So my time is running out, but here's the bottom line I want you to answer. Is it fair to say that these private equity firms would then target single-family homes in majority African-American neighborhoods more than in majority white neighborhoods?
Yes.
Thank you very much. I yield back, Madam Chair.
Thank you very much. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairman. And for full disclosure on everybody in the call today, I am a small business owner and I am an investor. Now, as we are having these conversations, some of these questions I hear are coming out of left field about the housing market. We should take a second to recognize where the Biden economy currently stands. And it stands with everybody, not just one group or two groups. Everybody's being affected by the bad decisions coming out of this Biden administration. American savings rate, it's at its lowest level since the Great Recession. And while credit card debt is hitting all-time highs, supply chains are broken, having visible impact when our constituents go to the grocery store with empty shelves, but also on inventories for other small businesses. And I'm in the car business. I just said that I'm a small business owner in the car business, and we usually carry around 800 units on the ground. And today, as I sit in one of my businesses, we only have 26 units on the lot for sale. So I can tell you about supply chain. The supply chain problems are making it particularly difficult for commercial and residential real estate industries. Projects are being delayed because they can't find the raw materials necessary to complete their bills. And when timelines get stretched out because of unforeseen circumstances and inflation, the overall cost goes up. Even if these builders are able to secure all the necessary materials, they are having real problems in finding skilled workers to complete these new projects. And inflation is at a 40-year high as a result of out-of-control government spending by the Biden administration and too accommodative monetary policy. This has forced the Federal Reserve to raise interest rates at unprecedented pace to get these unprecedented price increases under control. And this has led to the 30-year fixed mortgage rising to a 14-year high this week of almost 6%. To put a perspective into it, a year ago, this mortgage rate was sitting at 3%. This is a massive year-over-year increase coupled with home prices hitting all-time highs and are not making this a buyer-friendly environment for anyone. And as a result, all of these factors, consumer confidence is currently sitting at its lowest level since the start of COVID pandemic. The Biden economy just simply is not working. So needless to say, we have a long way to go before Americans are confident again in the direction our economy is heading. So, Mr. Michel, can you give us your opinion on how we got to this point, and then what steps we need to take to get our economy back on solid ground?
Well, I mean, part of it again is I think on the inflation side is the fiscal spending. Part of the supply chain issues, or largely the supply chain issues, are due to the COVID government shutdowns. You had an incredibly large drop in demand and then snapped back in demand, bigger than anything in the historical record. So we have to be a little bit patient. We also have to stop spending more at the federal level. It's only exacerbating supply chain problems. We only have so many resources to go around. You don't want to keep bidding them up. And then on the other side, I think the Fed's actually doing what they should be doing. The Fed has started tightening. At this point, monetary policy is probably the only tool that's going to help long term. And there are signs that that's starting to work. Credit markets are tightening. Money growth is coming down. Some signs of core inflation kind of turning back. So, I mean, I think we're on the right road as far as that goes.
Well, and we need to quit talking about tax increases. We need to keep taxes where they are. And
yeah, I don't really understand the tax increase thing, but go ahead.
Yeah, I don't understand it either, but we'll move on to that for later. Excessive regulations are important. They can be a major drag, as you know, on the economy and private sector participants. And there's been studies that have been shown in President Biden's first year in office, businesses have spent over 131 million paperwork hours complying with these new regulations. And I can tell you about that. I'm in a business that's all commission. And my business, we've even had to hire a compliance officer and pay him a salary to comply with these regulations we're getting burdened with. So this takes away valuable time away from productive activities that could be adding value to the economy and helping people to buy houses. So we must always be looking at ways to free up businesses' time so they're not consumed with productive activities. So real quick, have you previously done some extensive research on the Dodd-Frank Act, and can you discuss certain parts of the bill that would lead you to believe we're holding back the economy that we could re-examine in this committee?
Sure. I definitely Title I of Dodd-Frank with systemic risk and financial stability regulation, given the Fed and Treasury sort of a blank check to go out and just do anything in the name of guarding against potential systemic risk and failure. And that's showing up in crypto and fintech markets right now.
Okay. My time's up, Madam Chair. I yield back.
Thank you very much. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the subcommittee on housing, community development, insurance, is now recognized for 5 minutes.
Thank you, Madam Chair. Let me first of all just sort of deal with some of the issues that have been thrown out, Mr. Michel. First of all, I appreciate your appearance here before the committee and presenting information. But what I'd like for you to address is if there is a $2 trillion drop out of the revenues of the United States, does that contribute to inflation?
A drop in tax revenue contributed to inflation?
Yes.
No, I would not make that argument. Maybe there's another way you can make that argument, but I would not make that argument.
So dropping $2 trillion
in tax
tax revenues is not as devastating on the economy as spending $1 trillion for infrastructure. I mean, is it connected to who does it or what? I mean,
well, if you're asking me if one is inflationary and one is not, then I'm going to say that if you drop $2 trillion in tax revenue out, it's not inflationary. And if you put $1 trillion of spending into the economy, that it is inflationary. And I guess if that's where this is going, where if we have inflation, all we need to do is increase taxes, I don't know that that's actually equitable. I don't know that it actually works that way in practice.
I didn't suggest that. I'll play it back. I don't think I suggested that. If I did, I misspoke. If I said that, what I'm trying to deal with is, we spent $1 trillion. We had a $2.3 trillion hit on the economy with the tax cuts, and the revenue fell or is falling substantially short of the 2.3 trillion. So, hopefully we'll get to a point where, something is right or wrong because it's right or wrong and not who did it. And so, the $2 trillion drop hurt us. And let me ask you one other thing, and then I'll move on. My assumption is that you oppose the bipartisan infrastructure bill that we some of us proudly voted for, Republicans and Democrats. Is that true?
Correct. I don't think that was a good bill.
Okay. And so what would you say to, let's say, the people who are concerned about the 45,000 bridges in poor condition in the United States? Or what, I'll tell you this, what would you say to the people in your community who didn't need this stat to realize we were in trouble? That we rank 13th in the world in terms of our aging infrastructure. 45,000 bridges in poor condition. What do you say to the people all around the country who believe we were in trouble? And what would you say to every president since Bill Clinton has said they wanted pass an infrastructure bill? We need an infrastructure week where the legislative process is going to begin. So all of those people had to have been wrong that we desperately needed an infrastructure bill. Is that what you're saying?
Yes, I would say that that's wrong. Yes, and I would say that they're politically very popular for every president and most congressmen and senators. Yes.
But why is it popular? Is it because here in Kansas City we're getting ready to put in new bridges where we were having flooding where 25 people died? Is it something that I should be apologetic about? I voted for it very proudly, and I have not heard a single Republican or Democrat or vegetarian or anybody else has complained about it.
No, if I were you, I would want to get as much money as I could from my constituents from as many places I could get it from.
Thank you, Madam Chair. I appreciate the opportunity to, and I thank you too for your, Mr. Michel, for your president of our committee and your answers.
Thank you so very much. You can add to that clean water, Mr. Cleaver. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Well, thank you, Madam Chair. I've certainly enjoyed this macroeconomic debate with our witnesses and our members. It's always rewarding, I think, actually. I'm sorry we're not in the committee room together today. I would say to my good friend Greg Meeks that I appreciate his work on building bipartisan support for targeted support in Ukraine with our European allies. I didn't quite take his messaging that somehow Republicans don't support that. So I wanted to thank him for his working to make sure we have bipartisan support there. But I do want to correct the record from my good friend, Brother Cleaver in Kansas City and Greg on this tax issue. The Tax Cuts and Jobs Act helped all American families, brown, white, and black, with lower tax rates, easier filing, a better child tax credit. We need to make those tax cuts permanent. That should be a priority for Democrats and Republicans. Secondly, on the revenue issue, corporate tax revenues, despite the large cut in the rate, are at their highest level in American history. We are earning more corporate tax revenue than we have in the history of the country, and $1 trillion came back into the U.S. for U.S. investment there. So I think that the gentleman's argument about revenue loss is quite exaggerated there. And the real challenge that we're talking about today is the impact on supply chain and Biden inflation and the impact on housing affordability. And it is devastating, as I said in my opening comments. And I want to start with Dr. Chandan. In your testimony, very interesting. You say the analysis shows nationally institutional investor share of the market has risen since just prior to the pandemic, but only accounts for 2.5% of home sales. By comparison, individual investors and mom and pop investors in our towns and cities and counties account for 24% of the market. So, Dr. Chandan, is there evidence that this is only in low-income neighborhoods, or is it across the board in these growing metro areas? Let me ask you that.
Thank you, Congressman Hill. I think the data that you cite and that I cite in my testimony is provided by Freddie Mac in a just recently completed study. While there's always opportunity, and here there is significant opportunity to improve data transparency and availability, what we do know is that nationally, 24-25% of investors in markets that are buying single-family homes without the intention of living in them, or reselling them, but of repurposing them as single-family rental homes, does include a wide range of investors, and we should be careful not to conflate, large institutions with that entire pool. And so about 2.5.
Thank you. Let me reclaim my time, because the marginal investor in your data you presented from Freddie is an individual mom and pop investor, not per se the institutional. So number two, I've never seen anything that it's disproportionately in low income neighborhoods either. So let me ask you this. A lot of families have kids, and the number of kids in the rental market, a lot of apartments don't have multi-bedroom units. Isn't the best place for a mom with kids who has multiple kids, sometimes a single family home? Isn't that a better choice for her rather than an apartment where they don't have as much choice and no yard?
One thing that we absolutely do observe is that as households age in their life cycle, in particular, as you point out, as they have their first children, the set of amenities that they look for changes and expands, and in many cases will include things like parks, good quality public schools that you get better access to when you live in a home, in large part because of its location. For some families,
let me thank you for that. If you have other comments on that, please submit them for the record, because I think this is a key element of what we're talking about today. Also looked at the affordability chart, looking at my favorite source, of course, everybody loves the St. Louis Federal Reserve Bank, and it shows that minority home ownership skyrocketed under the Trump administration from its post-crisis low of basically 2016, 2017. And then the pandemic knocked off that home affordability and ownership rates for Black, brown, and white Americans. So we need to get back on that. I thank my chairwoman, and I yield back the balance of my time.
Thank you. The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thanks, Madam Chair. My friend, Mr. Hill, I think is started off on the right track. I'm not sure he ended on the right track, but he started off on the right track by talking about this being a macroeconomic kind of question that we're asking. It's also microeconomic. And I would just say, we've had some questions about supply and demand. Listening to Dr. Michel, he doesn't really want to mess around with the supply. He wants to cut the demand, and he cuts the demand by making sure people don't have any cash. Okay, that'll work. All of a sudden, then there'll be an oversupply. In Colorado, long before Joe Biden took office, we've seen house prices increasing because we've had our population increasing and have had the supply hasn't kept up with the population. That's really what's happened in Colorado, probably other places in the country as well. The Ohios, maybe Arkansas, maybe New York, there's been people leaving and house prices have stayed stable or maybe even dropped. I guess a question to the entire panel, and Ms. Pope, I really appreciated your economic analysis of things, probably the best, but just a bigger question, demographically in the United States of America, do we have enough housing for our population? And where do we see our population going over the next 10 years? Do we think that the supply will keep up with the demand, or do we see demand shrinking? And so I'll start maybe with you, Ms. Pope, and see if you've considered sort of the demographic question, or if you have to look at it on a market by market basis.
Thank you so much for the question. In the future, I do not see the demand, or I do not see the supply increasing. The demand is much higher than supply right now. And you got to remember, home buyers in America, when they're purchasing home or looking to buy, and the offers that are coming through the properties are at least 5 to 10 times more than it's been in the past. Those same buyers are now in a renting capacity. So now they're sitting ducks. So when you look at all of those buyers that can't buy because of lack of inventory, the demand is strong. The supply is going to take time unless we build and we do more housing, within the cities, within the suburban areas, so that homeowners can be able to buy. So the demand is very low. The supply has to increase. That's the only way that home buyers can purchase the property. When you're talking about the offers that are then, as I mentioned earlier, it just doesn't work with that. It's just not enough properties, and we need the help to have Congress. Anyone can help, especially with the NARAB group, to help so that we can increase the supply so our buyers can purchase. But I don't see the supply happening that fast. I do not.
Okay, thank you. Mr. Calhoun, you had a chart that you wanted to show with ups and downs of the housing market over the last, I don't know how many years. But I'm curious if you've taken a look at demographic trends nationally, because it seems to me that sort of the birth rate is down. I don't know about the immigration rate. It goes up and down. But talk to me a little bit about how you see supply and demand on a general basis, not the monetary supply, just people and housing stock.
Yes, and there are a couple of factors that make it clear that we have an absolute housing shortage. And I note that our fellow panelists from the Urban Institute, they have done research on this. One factor to put in is we have an aging housing supply. It is not keeping up, and there is obsolescence with about 1 to 2% dropping out each year. And so even with steady state, you have to take that into account. But the big thing is that we are experiencing a huge shift. The new households are predominantly households of color, younger households who will be looking to buy homes. And in addition, we have a factor with current older households, a trend towards families wanting to age in place for a longer period rather than sell that house and free it up for recycling. We have got to remove barriers to the construction, particularly for the entry-level market, and that is an absolutely critical part to keep us where we are, but we also have to move forward.
All right, let me stop you for 1 second just to make a kind of a final comment. I know in the Western United States, the interest rates have already taken effect on the housing market. Land development has slowed, new construction has slowed, and home sales have slowed. And so any comment on the interest rate increases before my time expires, which expires right now. So you're not going to get a chance to answer. I yield back to the chair.
Thank you very much. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Mr. Waters. First of all, I've been probably for over 45 years built houses. I built apartments. We developed property. Quite frankly, some of the responses has been laughable. And the Democrats can pick who they want on the 20-some hearings we've had. This is my second hearing, but you might want to get people that have been in the business that can give you some real live experiences. The number one issue that's causing housing prices to go up is very simple. It's the war this administration has put on oil and gas. Now, the trucks that delivered a load of lumber to our house today was
Excuse
not
me, Madam
powered
Chair,
by.
I cannot see Mr. Norman. Are you on,
How
Mr.
about-
Norman?
Oh, yes, I'm sorry. Yes, ma'am.
I don't see you on camera, sir.
Okay, hold on. Let me get some.
There you go.
You got it? Oh, can you see it now?
Just your friend, Texas.
Okay, can everybody see it? How about now?
You're good. Nope, we lost you again.
Okay, Austin, can you come in and see if you can? Maxine, can I have?
Is this
Let me
Foster?
get this straightened out, and I'll have my. What's going on here?
Mr. Norman, the gentleman from South Carolina? I can't.
Yes, ma'am.
Yes, you're on. We don't,
Okay.
we can't see you. Is your video on? Mr. Norman?
Video's on. Let's see. Yes, ma'am.
We need to see you on. Okay.
Okay. Can I?
You're coming
Can
on?
I just come? I can't. We can't get it. Can I come back again? Can you
Yes, I
call on
will
me?
come back. No
I'm sorry.
problem.
Thank you.
All right, thank you very much. Let's go to the next person. The gentleman from Illinois, Mr. Foster, who is also the chair of the task force on artificial intelligence, is now recognized for 5 minutes.
Thank you, Madam Chair. Am I audible and visible here?
Mm-hmm.
Thank you. Yeah, so I am struck by the fact very often that it seems like we put a lot of effort into house construction, but not necessarily the right houses. That, you know, if you look around at the number of empty nesters sitting around in McMansions with large numbers of empty rooms, yeah, I bet we could cure the problem with people who are homeless in this country if we could somehow snap our fingers and reallocate that effort. And so I'm a fan of the free market in almost all circumstances, and I'm a little bit distressed by everything that's put into place to interfere with the free market in ways that lower the ability of people without a lot of means to purchase houses that they might be able to afford. And so I was wondering, what are the most cost-effective interventions in the free market, or maybe just returns to the free market that would allow people, that would allow the supply and demand for low-end housing to line up, or removal of subsidies that we have in place for, or rules, that encourage people to build big houses on big lots instead of a small multifamily. Does anyone want to take and I'm interested in, we will have to put some federal money into this. What are the most effective subsidies, and where can we put them, either on the supply side or the demand side? Yeah.
If
yeah,
I may, if I may respond, I'll note for the record that I have both run billion-dollar home lending programs to families of modest means, and I've also been a private real estate developer and have experience from that side as well. A couple of things that we can do, we suggest are being piloted now, is to help families, as I mentioned in my testimony, through the vulnerabilities of today's more volatile world. Gig economy workers shouldn't be precluded from having a chance at home ownership. And those are things like reserve funds, which our partner lending institution is piloting, as well as loss of income protection insurance that helps people make up for the deficiencies, quite frankly, in today's unemployment insurance programs. But those, again, one of the things that we missed in this hearing is we are in a different world than we were in 2008, thanks to Dodd-Frank. People have affordable mortgages right now. We are not facing a dramatic plunge in pricing because of foreclosures as we did in 2008. We have made lending more sustainable. We just now need to make it more inclusive, like it was in the 50s and 60s when we brought millions, tens of millions of white families into the middle class through very affordable FHA, VA loans that go up to 100% financing. If those are properly underwritten with responsible programs such as reserve funds and loss of insurance, loss of income insurance, you can do this in a way that is safer and more inclusive and relies on the free market to deliver the housing we need.
Yeah, thank you. But there's still the short-term problem of total amount of lumber. And so it seems like part of the way out of that is to allocate the lumber toward building smaller units, more smaller units. Dr. Chandan, you look like you wanted to say something.
Yes, sir. I mean, when we look at sort of the deterioration in the share of units being built that are small or entry level, we're down to about 7% from something that was significantly higher. The average home under construction right now is 2,500 square feet. It's not an entry level home. A lot of this is at the local level. The availability of materials and skilled labor is certainly an issue. Another is local zoning that limits the ability to use smaller parcels of land or to build smaller homes. Another is an allocation issue where in some parts of the country, local transfer taxes or the costs associated with buying and selling are high enough that, at least on the margin, it will inhibit some families as they grow from moving into right sizing into a larger home, opening up the supply of entry-level homes. You stay in that small space a little bit longer than you might otherwise because the transaction costs are high. Those are all things that, in particular at the local and state level, that we can begin to address that are largely in sort of the regulatory and zoning environment.
Thank you. And it looks like my time is up.
Thank you very much. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you,
Mr. Rose?
Give me just a second.
All right.
I should be unmuted. Are you hearing me? Are
You're
you hearing
breaking
me?
up.
All right. I am doing this remotely, so I apologize. Are you hearing me any better?
Yes, I hear you better. Go right ahead.
Thank you. Thank you, Chairwoman Waters and Ranking Member McHenry, for holding this hearing, and thank you to our witnesses. Before we get into my questions, I just wanted to make a few comments. Earlier in the hearing, the Chairwoman referred to this committee as the, quote, Democratic Committee, end quote. I think that this is one of the problems with the committee as it is currently constructed. It should be the Financial Services Committee, of course, not the Democratic Financial Services Committee. That's why we get some of these hearing titles that show you before the hearing even starts that it will be biased and not a serious, I'm afraid, examination of the issues. Additionally, Mr. Sherman stated that the Democrats' Build Back Better Act is fully paid for. This was directly contradicted by the Nonpartisan Congressional Budget Office, I'll point out. And I would also like to echo some comments at the outset that have been made by my colleague concerning the proposals that are attached to this legislative hearing. We are over $30 trillion in debt. We are experiencing the highest inflation in over 40 years. Gas is $5 per gallon. And the majority has chosen to attach proposals to this hearing that would spend money we don't have, put people in houses they can't afford, and exacerbate the inflation that is hurting everyday Americans. On December 6, 2021, the Financial Crimes Enforcement Network Fincen issued an advanced notice of proposed rulemaking on anti-money laundering regulations for real estate transactions. The proposed rules would apply to non-financed real estate transactions. Fincen already applies its framework to finance real estate and commercial transactions, as well as all cash residential transactions. If this rulemaking is finalized, anti-money laundering requirements would be extended to virtually all real estate transactions. Dr. Michel, do you see any issues with expanding Fincen's reach in this area?
I'm sorry, the very last part, do
you see any issues with expanding Fincen's regulatory reach in this arena?
Yeah, I mean, it's kind of mind-boggling to me. I don't know why we would do that. I don't think there's a regulatory issue here. This is a supply-demand issue and not more than that. So that, yeah, I wouldn't be in support of that.
And on a similar note, I have previously expressed concern that the federal government uses the Bank Secrecy Act to deputize the private sector to collect personal data from American citizens. Dr. Michel, you have previously recommended that Congress should simply require financial firms to keep customer records and then have law enforcement abide by the Fourth Amendment to access those records. Could you please elaborate on this approach?
Yes, I think that that would be a way of handling this that is completely consistent with the constitutional protections that we're supposed to have. If you're accused of a crime, that's one thing. If you're not accused of a crime, then you shouldn't be subject to law enforcement actions. So the way it seems to me, the way to handle this with the Bank Secrecy Act is to say that the bank will keep records so that we can identify customer transactions. And if there is somebody who is legitimately suspected of a crime, then law enforcement will, just like in any other criminal investigation, go get a warrant, and then they can go and get that information. That's not a problem in any other criminal investigation, so it shouldn't be in this case.
Thank you. I entirely agree with that assessment. Dr. Michel, has the Fed's purchase, kind of shifting gears, has the Fed's purchases of mortgage-backed securities put upward pressure on housing prices?
I don't think it's the biggest component, but yeah, the direction has to be upward price pressure because it is increasing liquidity to some extent in the MBS market, making it easier to get loans. So it's magnifying that problem, yes.
And Dr. Michel, as you know, Democrats on this committee have been trying to expand the Fed's set of responsibilities to include things like racial inequality and climate change. Do you worry about proposals to expand the Fed's mandate, and what impact do you think they could have on housing? Should the Fed's responsibilities be narrower?
I am worried, and I do think it should be narrower, not broader.
Thank you. I think my time has expired. Thank you, Chairwoman Waters, and I yield back.
You're so welcome. And if it would make you happy, I wouldn't hesitate to call this the Republican Democratic Committee if you would give us a vote on housing, okay? The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Thank you, Madam Chair, and I would like to again welcome everyone to the committee. One of the things that I was thinking about is back in, I think it was 1972, when I was trying to get a house for the very first time. I remember the house was about 21.5, and so I went to FHA Barrier, but I noticed today that FHA is disproportionately the way that people of color sometimes go out and borrow money for housing. Haven't had a competitive disadvantage in the housing market. The share of FHA insurers mortgages have fell now to around about 18%. And it looks like here, basically in 2020 and to 2021, continue the downward trend towards a lower level, I would say up until about 2012. If the present trend of increased home purchase continue as projected, how could sellers be encouraged to conduct business with the FHA borrowers when the cash buyers can offer incentivizing offers above the asking price? And this is to the whole panel.
Hi, this is President Pope. Thank you so much for that question. You know, sellers, you're right, they can take offers as cash buyers. We can't steer them. But what we can as real estate practitioners, at least educate your homeowners, your sellers about the different type of financing. Sometimes cash is not the right way to go. Sometimes it's a better way to finance because you get more money. Sometimes the cash borrowers are charging less than more because you think you can close in 7 or 10 days. A lot of times we find out that a couple more weeks later, you could have given that homeowner a better opportunity to buy a home. So I would suggest that real estate agents being educating their sellers on the different options and why it's important for home ownership.
Okay, anyone else on the panel would like to respond? Anyone else would like to respond?
I will add, FHA can be more user-friendly. It has been constrained, as you know, in that it relies totally on appropriated funds for its operations. And it has historically been underfunded. It has played catch-up recently, thankfully, through appropriations over the last few years to upgrade its technology. But FHA needs to operate with the same resources that other lending options do so that they're equally competitive. And right now, they are very much still resource constrained, which makes them less user-friendly for both borrowers and sellers.
Okay.
I would just like
Go ahead.
I would just like to add that so one of the things that we do have to think about, I think it's also related to the last question about why white households are more likely to have the rich uncle in the first place. And that is an outcome of many of the prior policies that have been in place in this country. The only way to reverse that trend is actually to lift up those people who have been previously discriminated in the market. And just leaving alone in the market would not solve the racial disparities, as we have seen multiple times in the year. We have seen that the racial disparities have increased over time, and then the Black households were disproportionately impacted during the Great Recession. They have lost a huge wealth in the market. And then one of the reasons is because they have been a target of predatory lending practices, and subprime loans made a huge impact on their wealth. And these subprime loans, the data shows, and a lot of academic research shows, that these subprime loans and predatory lending practices were more prevalent in the private sector. So I don't think the argument of blaming the government that on every issue actually makes sense. And I don't think it's actually the core reason that we are seeing the racial disparities that we are seeing in the housing market right now.
And I might not be able to get into this next question, but I had a townhouse, and recently, I get all these calls from outside people saying that we would like to buy your townhouse. We'd like to buy your townhouse, and we got the most competitive offer that we can give you. And those calls come in all the time, but I don't guess there's anything that we can do about that, because that really affects the market, whether the townhouse or other rental units. And so, since my time is about run out, Madam Chair, I will yield back.
Thank you. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Madam Chair, and I thank all of our witnesses for being here today. Yesterday, during an oversight subcommittee hearing where Democrats attempted to create scapegoats for their left-wing policies ruining the housing market, one of the Democrat witnesses advocated for, this was great, for a government takeover of all private property and housing. A yes or no, please, from the witnesses. Does anyone on this panel believe that the government should own and operate all housing and property within the United States?
No.
No.
Let's just make it easier. Does anybody say yes? Is there one yes? Can anybody entertain me? Okay, there's no yeses. All right. This same witness for the Democrats also advocated during the pandemic that renters and homeowners should participate in a quote unquote rent and mortgage strike and withhold payments due to their landlords or lenders, whether they could afford to pay them or not. So I'm going to make this really specific. Do any of the panelists believe that during the pandemic, if someone did not lose their job, if they were not under financial hardship, that it would be appropriate for them to go on a rent or a mortgage strike? So do you think you have to pay your bills if you can? Anybody want to say that?
You should pay your bills if you can.
All right, great. Thank you. It seems that under the current majority's plan to address rising mortgage and rent costs is just to throw more and more money at the problem rather than addressing the root causes driving these price increases. The federal government has been heavily subsidizing housing for decades, with very little to show for it. In fact, home ownership rates among Black families have actually decreased since the Fair Housing Act passed in 1968. Yet my colleagues across the aisle, their plan is just more of the same, throwing money at the problem as if demand is the issue in the housing market, when we all know the lack of supply is what has long been driving increased costs in finding a home, whether that's to rent or buy. Just last week, this committee marked up the chair's Down Payment Toward Equity Act on a party line vote. This bill would give individuals making over $200,000, which is more than any of us make as members of Congress, almost $100,000 grants for home purchases. Putting aside what a terrible idea that is, Mr. Michel, how would the housing market respond to this type of grant program were it to become law?
Well, it's the same sort of phenomenon where you have you can look at a major drop in interest rates. What's happened over time is that that decrease, I'm sorry, has been capitalized in home prices. So the interest rate drops, monthly payment drops. It's the same sort of effect. You would expect that to be capitalized in home prices in a relatively short period of time, maybe a little bit longer than the interest rate. Sellers would recognize that somebody's already coming to the table on a regular basis with that first, say, $50,000 or $100,000 covered. Therefore, you know that you can increase the price. That's going to get capitalized in prices.
Well, you kind of answered it, but what would the inflationary impact be? Would it go up?
Up, yes. That would be the direction, up.
So in short, the chair's bill would make inflation even worse than it already is. Mr. Michel, could you explain to us how housing costs factor into the core price index?
Yeah. So it's not directly, it's a shelter-based service sort of price, where you have rental prices incorporated into it, and then for homeowners, it's a rental equivalent. So it's based on the value of homes, and those also affect rents. And then the service that you get out of that component of your shelter is calculated. So it's, to save the statistic part, with a lag, it goes into the CPI and it becomes a part of the index. And it's done with a fairly substantial lag. So we are probably going to see an elevated shelter component of the CPI for at least another year, no matter what.
Okay, so is it fair to say that this down payment grant program would directly counteract the actions being taken by the Fed to lower inflation?
Yes, in that it would continue to put upward pressure on the CPI through that housing component, yes.
Thank you. It is obvious that we need to be focused on increasing the supply of housing rather than pushing supply-side subsidies when demand is already sky high, especially throughout the Sun Belt, like in my state of South Carolina. We need more homes, not more subsidies. Thank you, Madam Chair. I yield back.
Thank you very much. The gentlewoman from Massachusetts, Ms. Presley, who is also the vice chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thank you, Madam Chair. First and foremost, for your leadership and for the class, decorum, and fairness that you exhibit every day in this role. Housing is a fundamental human right. Yet across the country and in my district, the Massachusetts 7th, millions of people do not have access to a safe, decent, and affordable place to call home. For decades, Black families have been locked out of home ownership opportunities due to discriminatory lending, and now private equity-backed institutional landlords have pushed this dream even further out of reach by gobbling up single-family homes and worsening the housing crisis across this country. Ms. Pope, the 5 largest single-family rental companies own almost 300,000 homes. Now, what are the consequences when institutional investors purchase these homes in bulk, often in cash, and how are they worsening housing affordability and forcing would-be home buyers into the rental market?
Thank you for the question. Let me start and say, again, when lenders hesitate, to lend to low balance mortgages, that means lower properties that's in neighborhoods buyers can't purchase when they're hesitating. And what that does, it opens up the doors, as I stated earlier, for investors who pay cash. They buy in bulks, the properties for less money, then there's wholesaling. it displaces the residents, and it creates low inventory for the neighborhood. So when you have these cash buyers, and cash investors, and a homeowner can't have that American dream because they're bought out of a cash deal, it makes it very difficult. Then they have to go back and try to rebid on properties. Number one, that makes it harder because now they're against many buyers who then are pricing higher than is normalcy, which pushes them out the market. It brings them into a mode where they have to rent because many of them are in a situation where the rental market is getting ready, or their rents are getting ready to either increase or is getting ready to end. So they have to either re-sign that lease another year. So it does stop a lot of provision from Black homeowners into buying homes.
Thank you. And Ms. Pope, most of these homes these institutional investors are buying up are in predominantly Black neighborhoods. So yes or no, based on what you are seeing, is the influx of institutional investors and cash buyers driving up home prices in predominantly Black communities, yes or no?
Yes.
And home buyers, Ms. Pope, are not the only ones impacted. Are these communities seeing rents go up as well as a result?
Absolutely.
And Ms. Pope, would you say that institutional investors are accelerating gentrification of communities of color and displacing low-income residents?
Yes.
Thank you. That is exactly what I've been hearing from people in cities across my district, like Cambridge and Boston, where rents have risen by 30 and 27% higher than last year, respectively. This is unsustainable, and my most vulnerable constituents are drowning financially because they cannot afford these rent increases. This hearing is about home ownership, but right now, home ownership isn't even feasible for many in my district who are being squeezed by predatory rent hikes imposed by institutional investors. Mr. Calhoun, you mentioned in your testimony that broad student debt cancellation would help address the racial home ownership gap. I agree. What other policies will provide relief to tenants facing unsustainable rent increases?
Again, a couple of things. We have to increase the supply of affordable rental housing as well. And then one of the provisions that expired in January, the children's tax credit. I mean, one of the things we talk about homeownership producing wealth, it's also a manifestation of people's existing wealth and existing financial security. Another thing is actually there's recent Federal Reserve research that shows that expansion of Medicaid increases not just general financial security, but home ownership. Again, what you've talked about, putting people in a stable financial position so that they can either securely rent or purchase a home. And if I may, I'd like to give a shout out to two programs that we need to lift up that have come out of Massachusetts. That is where one of the largest first generation targeting programs was implemented that was the basis for Chairwoman Waters' provision. And also it has one of the largest statewide income loss insurance programs, which again, we need those kinds of new approaches to provide efficient ways to address these housing problems.
Thank you. I was trying not to be too parochial or boastful, but I appreciate your lifting up those successful models. And again, thank you, Madam Chairwoman, once again for your steadfast leadership.
Thank you very much. The gentleman from Wisconsin, Mr. Stile, is now recognized for 5 minutes.
Thank you, Madam Chair. Appreciate you calling today's hearing. I've been listening along as we go today, and I continue to hear policies by those on the left that would actually exacerbate inflation. People are getting clobbered. I was recently at a gas station in Beloit, Wisconsin, yesterday, talking to a couple who were frustrated. They could barely afford to fill up their car with gas. They're frustrated with their grocery bills. Their rents are increasing. They are just getting clobbered. And they're getting clobbered because costs are going up. And what I continue to hear is all sorts of excuses as to why costs are going up rather than really looking at the real problem. And the real problem is that we have runaway spending in Washington, D.C. We have an energy policy that's on its head. We have a contraction of supply, in particular in energy. We got to unleash American energy because people are getting hurt every day by Democratic policies. And so I listened to what we're doing. I listened to where we were in the markup. We had this debate. We looked at billions of new dollars of spending, which would accelerate inflation. We just heard a proposal again. We saw it in the testimony about wiping away student debt, which of course really isn't wiping away. It just shifts the burden of who pays for it, and it shifts it into more debt that all Americans will pay for to the benefit of some of the wealthiest Americans, people that received graduate degrees as doctors, as attorneys. That's what helps. And what would it do? It would accelerate inflation. And so I want to ask you, Dr. Michel, if I can, as we listen to this debate today, and we're looking for real substantive solutions, is the challenge on the demand side that Congress should be subsidizing the demand side? Or is the problem on the supply side that we should be looking and focusing in on how do we sustainably increase the housing supply? And how do we consider that in this inflationary environment that the outgoing majority has put us in?
Sure. The mistake with the supply argument is, well, we just need more houses. And that's a mistake because it's looking at supply without talking about demand. You should be talking about supply relative to demand. And we know supply is relatively inelastic and fixed. They're always constrained housing supply markets. Therefore, the worst thing to possibly do is to constantly increase demand, which is exactly what federal policy does. So you're only going to get one result from doing that. And then to go to the sort of underlying issue, I think this is a great example that we just heard. If it is true that private equity firms are predominantly buying up foreclosed properties in poor neighborhoods, then the problem to address is the poverty, not the demand side loan and lending ability of all these government agencies. That's the way to address that.
Let's dive in on kind of what would happen if we accelerated dramatic new federal government spending programs as we think about the inflationary pressures that we're feeling here in the United States. We marked up a bill, would have spent another $100 billion or so. What would be the economic impact of pumping in another $100 billion into the U.S. economy that at the start of the Biden administration, Democrats on a party line vote passed $1.9 trillion in new government spending already? What we took the fire that's been started and we threw on $5 gallon of gasoline onto it?
You're going to get more inflation without clearing the supply problems. You're going to have, if you, for example, said, okay, from now on, everybody gets whatever loan they want. Well, they can go out and do whatever they want. That's fine. Everybody's going to be bidding on the same amount of stuff, the same amount of real resource constraints.
So if we pump in demand side subsidies to make it real clear, what happens to price?
They go up.
So if prices go up, does it make it more affordable or less affordable to a family in Wisconsin?
Makes it less affordable.
So the Democratic policies of pumping a whole bunch of more money in are actually, in the end of the day, going to hurt the people that we hear them claiming to assist. Is that accurate to you?
That is accurate, yes.
It's the same story we see on energy policy. It's an attempt to contract supply on the energy side so that we don't unleash American energy, so we jack up the prices, so we have some sort of transformational change, and it's clobbering people every single day. And then we come over to the housing side where people are getting pinched by higher rents and unaffordable mortgages, and we see the Federal Reserve have to raise interest rates because the Democrats are awash in runaway spending. And as interest rates go up, it's even harder to get into a new home. It's harder to save for your down payment because of the inflationary pressure we're in. The hypocrisy is thick. Dr. Michel, I appreciate you being here. Cognizant of the time, Madam Chairwoman, I'll yield back.
Thank you very much. The gentleman from Massachusetts, Mr. Lynch, who is also the chair of the Task Force on Financial Technology, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for having this hearing. This is probably one of the most pernicious problems that I deal with in our district. I represent the other half of Boston that Ms. Presley does not represent, and we're really struggling with housing costs all across my district. Dr. Chandan, I noticed looking at the housing data that the applications for mortgages have dropped off considerably, but and that's understandable with the rise in interest rates. But I also noticed that the number of people applying for an adjustable mortgage has basically doubled. And I was here in 2008 on this committee, and I saw what happened there when mortgage, when adjustable mortgages reset, and people got stuck. The valuations of their home was going down, and yet their payments were going up, and we ended up with a housing crisis. Have there been any protections that are available now under today's circumstances that were not available then that might prevent us from going into a similar tailspin?
Thank you for the question, Congressman. I think as compared to the housing boom bust and financial crisis, there are a number of changes that have been made in the market. The adjustable rate mortgages of today, do not have the same risk profile as those made during the during the housing boom. We don't see teaser rates. We don't see rapid succession of resets. We don't see penalties on refinancing into a permanent mortgage. That being said, adjustable rate mortgages ultimately do reset. And so it is important that borrowers, when they are particularly aspirational borrowers who may be income constrained, that are reaching for that housing opportunity, that when they are taking an adjustable rate mortgage, that they are mindful of and are well informed of the potential risks that those products present.
I appreciate that. I do see there are quite a few products out there that are 7-year resets. So the buyer has some lead time there, and I think there's an open question of where we'll be at with interest rates in 7 years, and the value of their home could be exceedingly greater at that point. So they might have a lot more equity and they could deal with it. Mr. Calhoun, is there concern out there? Is there a reason for me to be concerned about the increase in the number of adjustable mortgages? I mean, this has doubled pretty quickly, a matter of weeks. It's spiked. So is there concern out there? Is there a reason for concern out there?
There's reason. Thank you for the question. There's reason to watch it carefully. We are in a very much different world than the mortgages in 2008, which actually had built-in increases even if market rates did not increase. But most borrowers have trouble with shocks to their mortgage payments. I think perhaps an even bigger risk that we face right now is there is heavy marketing of cash out refinances today. And they come with the double whammy of not only are you doing that with a high interest rate, you're giving up typically a much lower fixed rate to get that. And the regulators in our housing agencies need to be very vigilant to protect consumers from that kind of predatory lender loan flipping. I think that is the big risk that we face out there. The CFPB has done a good job of keeping protections on adjustable rate mortgages. But again, this is a place where consumers have a hard time understanding the impact of the increases and being able to absorb those shocks. So thank you for keeping an eye on this.
Thank you. Ms. Pope, do you have anything you want to add on that? I know you're keenly aware of this problem. I just would like to get your perspective.
Yes, thank you. I'd like to add to that, that when the home buyers or the homeowners are looking to get rates and they're higher price, our best advice, especially coming from the National Association of Real Estate Brokers, is to look to a housing counselor. It's a free service. It educates them. It provides the understanding of these mortgages so that they're not going into these default loans. We do have an affiliate, NID, and that's our nonprofit. And we look to them to do these so that the homeowners can understand what they're getting. That's what I would add to Mr. Calhoun's statement. Thank you.
Thank you, Ms. Pope. Madam Chair, I'll yield back. Thank you very much again for having this hearing.
Thank you very much. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes. I know that Mr. Norman had some problems early on and he could not be on the screen. And evidently those problems still exist. And we will just keep going and we will try and get him before the end of the hearing. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Chairwoman Waters, Ranking Member McHenry. This is a very important hearing, and I certainly appreciate your having it. Thank you to our witnesses for your testimony. Mr. Calhoun, in your testimony, you cite the affordable housing shortage as contributing to the issues that renters and buyers are facing. And well, just yesterday, our committee held a hearing on the single-family rental industry and the role they've played in snapping up starter-priced homes, further constricting the already tight market. The homes that these firms are purchasing are not surprisingly concentrated in predominantly Black and brown neighborhoods. And the same is true here in my district in Charlotte, in Mecklenburg, North Carolina, where investors are willing to pay well above market prices in cash for homes and are acting as a gentrifying force. So can you discuss why addressing the housing shortage is imperative to improving housing security and home ownership opportunities for all Americans?
Thank you for the question, Representative. Absolutely, particularly as others have mentioned, in the starter home market is where we're feeling the most crunch for supply and available homes, and that is where we're seeing a lot of these houses being picked up. The first thing we should do is our federal housing agencies, as well as the GSEs, should stop their auction sales of distressed loans in REO properties and should instead put them back into individual home ownership. Because when they auction them, even with some set-aside programs for nonprofits, overwhelmingly these go to institutional investors who are the ones who are able to afford to buy a whole pool of loans. And that's where a lot of them get snapped up. They also are buying individual homes, as you've described there, and that is a concern, and we need to both provide more affordable housing and not unnecessarily see it siphoned away out of the home ownership market and the affordable rental market.
Okay, so that's what we can do to ensure that we don't see this transfer of housing and wealth from America's families to Wall Street. That's your opinion.
That would be a big step in at least slowing that down.
Well, thank you, sir. I am proud to be the lead sponsor of H.R. 7078, the Lifeline Act, along with Representative Rouser, Senators Leahy and Collins, a bill that would already appropriate dollars to be used to support LIHTC funding housing development and would free up over $8 billion in fiscal recovery fund dollars for affordable housing. We've got over 100 national and local groups endorsing the bill, including the League of Cities, Conference of Mayors, National Association of Counties, and the National Association of Home Builders. So I do want to encourage all of my colleagues to sign on to this common sense legislation. And Dr. Chandan, in your testimony, you concluded that we need a multifaceted approach to enhancing affordable housing supply. So can you briefly discuss how increasing the housing supply, be it through public housing investments or more LIHTC fund housing, could immediately blunt the negative impacts to renters that we have observed? I think there's some kind of problem, Madam Chair, with the
where that sound is coming from. Do they have financial services staff?
If it's helpful, Representative Adams,
Right.
I can address that while he is getting.
Mr. Calhoun, would you?
Yes.
I think the sound is gone. Were you responding to Ms. Adams, Mr. Calhoun?
Yes.
Please go right ahead.
Your bill 7078 is a great way to leverage and expand one of the most successful programs, the LIHTC, low-income housing tax credits, for adding to sustainable and affordable rental properties and allowing it to use the FSF, the fiscal recovery funds, is a very efficient way to do that. And we certainly join the endorsement of that bill and urge its enactment.
Thank you, Dr. Shannon. We've got 30 seconds. Did you want to respond?
Yes, if you're able to hear me, I think that Congresswoman, the low-income housing tax credits is probably the most effective program we have in this country for addressing the housing needs of our most income-constrained families. And so expansions of that program that would allow for increases in and preservation of the low-income housing supply are going to be absolutely critical. It's not a surprise to me that there's broad support for this program.
Great, thank you, Madam Chair.
Yes.
3 minutes, 3 seconds back. Thank you, I yield back.
Thank you very much. All right, the gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes. Is Mr. Norman back?
Thank Madam Chair, can you hear me?
Yes.
Okay, how about see me?
All right, you're recognized for 5 minutes.
Okay, thank you so much. First of all, thank you for this hearing. As so goes housing, so goes our economy. I think most economists recognize that. I've been building houses, both commercially and residentially, for over 45 years. And quite frankly, if the problems we're having now, and I've heard a lot of people with answers, the problems we're having is very simple: gas and oil prices. The truck that brought lumber to the house today was not powered by solar panels. It was not powered by wind. It was powered by natural gas. If this committee really wanted to get to the bottom of this, high gas prices, it affects over 137 different subcontractors within the housing industry. Subcontractors by meaning the sheetrock hangers, the footings, people that dig the footings, the painters, the architects. And to have a 106% increase in gas, that's what's driving your prices up. Secondly, it's not being able to get workers. This administration paying people not to work is a severe problem. Thirdly, supplies. I tried to order windows today, a simple window. Guess what kind of time frame we're talking about? 17 months. 17 months for a simple window. So for those of you who have an ear with this administration, beg them to, let's start producing our own oil and gas, and let's get away from buying it from rogue countries like OPEC. Now, I've heard a lot of the blame game going around. I've heard the theory that algorithms are at fault. I don't understand that logic. I've heard the opinion that appraisers are a problem and that they appraise minority homes less. For those of you who have never done this, the banks, the lenders determine who the appraisers are. The appraisers don't know if they're going to a house of a white person, a black person, a red person. They don't know that. They appraise what they see. And the fact that I think Ms. Pope said there needs to be more black appraisers, appraisers are needed everywhere. So it doesn't matter the color of your skin. I've heard the theory that institutional buyers reduce home ownership and that somehow they're to blame. Institutional buyers buy from that mom and dad who have owned a home for years, that young couple who have maybe owned a home for years and want to sell. Now tell them that the institutional investors are bad. They're just doing what they do best, which is invest in the capitalistic system, and they help the housing market. I've heard the question, why can government get involved to make developers build on bigger lots? The very simple answer is people don't want big lots. The reason people rent in a lot of cases is because they don't want the headaches of owning a home, of keeping it up, of paying the taxes. So the blame game is directly the responsibility of this administration. Under the Trump administration, home ownership for everyone was at an all-time high. And quite frankly, if you want to really get the job done, you really need to talk to whoever's running this country and tell them we got to get the oil and natural gas back. And the blame game has got to stop. Putin didn't cause the gas prices to go up. Russia didn't cause it. Santa Claus didn't cause it. It's this administration and their lame policies that are killing this country. Inflation is 100% tax on every American, regardless of the color of your skin. Let me just say this. We really need to have, and I appreciate this panel, but you need to be I would suggest having people who have actually been in the business. These armchair quarterbacks who have never done it, it's like going to a doctor who's never operated. He's read about it, but he's never operated. Or would you get on a plane with a pilot who has never flown a plane? He's read about it. So I would suggest, if we really want to get to the bottom, get people who've experienced housing at its basic level will get the problem solved. And I would just ask that we have more hearings in person. I apologize for the technical difficulties. And Madam Chair, I yield back the balance of my time. Thank you so much.
Thank you very much. Yeah, we do decide who our witnesses are. And so that's the prerogative of the chair and my staff. Thank you. The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you so much. Mrs. Pope, before the gas prices went up, did we have a housing crisis?
Absolutely, yes.
Yeah. How about you, Mr. Calhoun, right? Did we have a housing crisis?
We've had a housing crisis and a shortage of production of housing. By the National Association of Home Builders has described a shortage going back at least 6 to 8 years.
That's right. I think it's important to make sure we push against some of the gaslighting that continues to happen and understand this housing crisis is not going anywhere, has nothing connected to the cost of living. If anything, corporate greed and price gouging by many of the political corporate donors that benefit from the high price. Even though the barrel of gas is going down, the prices continue to go up. You know, Chairwoman Waters, I cannot thank you enough. You taught me that housing is infrastructure and that housing is a human right. And I know during this pandemic, cash buyers, as we all know, have intensified bidding wars, driven up the housing prices, and pushed many first-time cash-strapped home buyers out of being able to have their own homes. According to Renfen, cash buyers were 4 times more likely to win a bidding war against buyers with mortgage financing in 2021, as many of you have already testified to. I know the Urban Institute also found that 3 and 4 homes, though, priced at or below $100,000 are all purchased by all cash buyers and investors. This is very important to communities like mine. This disproportionately affected communities that I represented. More than half of the homes in my district right now, y'all, are valued less than $100,000. And the Urban Institute has found that it's actually more difficult for borrowers to get an FHA mortgage for a home valued at less than $100,000 than for a loan larger than $100,000. Why? We know this doesn't make any sense, and that countless home buyers, particularly first home buyers, are being locked out of being able to get home ownership, which really is a connection to economic stability and pulling people out of poverty. This has all impacted communities like mine, Detroit, which is over 80% Black community. This has resulted in Michigan actually losing more Black home ownership than any other state in the country. This is so important. So, you know, Mr. Calhoun, FHA borrowers are overwhelmingly first-time home buyers, as you know, and it impacts people like in my community, and an average have less financial flexibility and lower down payments. How can we get the FHA financing improved? How can we make it as a competitive financing option?
Thank you for the question. I'd say, first of all, we have great leadership at HUD with Secretary Fudge and great leadership with the former Center for Responsible Lending alum, Julia Gordon at FHA, who is totally committed in her career to doing this. A bunch of it is just plain resources at FHA. Again, by statute, they don't get to use any of the FHA premiums for operations. That's to insulate the reserve fund. But that means they're totally dependent upon appropriations and are tremendously underfunded compared to comparable private enterprises. So first of all, they need those resources, but they do have a number of initiatives underway. They were able, thanks to some special appropriations, to upgrade their technology, which saved them in the crisis.
No, I have and I do have, HR 1532, which is in the Senate, that actually directs HUD to be able, and there's no, financial impact on this, to be able to look at best practices for FHA to be able to look at these small dollar mortgages. Professor, is it Chandan? Should we expect this trend to continue, going upward? What can the federal government do, in your opinion, to ensure that homes get into the hands of, individual home buyers instead of these private equity firms and LLCs and others that are swallowing them all up?
Sure. I think that the key issue emerging from the data that we have available is that while there is a pool of buyers that are positioning homes for the rental market that would otherwise be available for ownership, that it is a very mixed group, and that we should not conflate the larger pool with that very large sort of private equity investor. That in fact accounts for only about 2.5% of the buyers. What I would suggest is that when we're thinking about the rental supply in this country, ensuring that we have a diverse supply of rental opportunities, whether it be urban apartments, whether it be single family homes, where someone wants the benefit of being able to live in that home, but is also making the trade-off. They don't want the obligations of ownership, but they're willing to trade off the benefits that come with ownership as well, and making that in an informed way, addressing the supply issues. When we look at what is being built, the average home under construction today is 2,500 square feet. That is not within reach of many aspirational buyers. Addressing many of the challenges we face at the local level to ensure that we're able to build smaller homes that are within reach of some of those otherwise single-family renters is critical here.
Yeah, thank you so much, and I yield, Madam Chair.
Thank you very much. The gentlewoman from, let's see, no, we got you. The gentlewoman from Pennsylvania, Ms. Dean, is now recognized for 5 minutes.
Thank you, Madam Chair. Are you able to hear me? I've had some technology problems myself.
Yes, we can hear you.
Wonderful. Thank you. And thank you for hosting this important hearing. Dr. Choi, I would like to start with you. I was struck by your testimony that unless we take action, you said the Black-white homeownership gap will remain unchanged for 20 years. Obviously, we cannot sit back and do nothing as policymakers. We have an obligation to try to correct that and close the gap. My district is Montgomery and Berks County, suburban Philadelphia. In my district, white home ownership is at a 76% rate, while Black home ownership is at 45, almost 46%, according to the National Association of Realtors, putting the Black-white homeownership gap at over 30%. Simply unacceptable. We need to take action to address this tremendous disparity. We know how important home ownership is for families to build wealth. It's not just about having a place to live. It's about being able to help your kid pay for college, to retire with dignity. One of the policy solutions you put forth to address the homeownership gap is targeted down payment assistance programs. So I'm proud to be a co-sponsor of the Down Payment Towards Equity Act, which authorizes a new HUD grant program to assist first-time, first-generation homebuyers in purchasing a home. I would love to see people in my district taking advantage of it. Dr. Choi, can you talk about how targeted down payment assistance programs, such as the proposed HR 4495, would address the racial wealth gap?
Yes, thank you so much for the question. So the existing programs, a lot of them have only income-only criteria. And then we do find that if we actually impose the first generation criteria on top of income, that actually expands the share of Black and Latino households who can take advantage of those kind of programs. I do acknowledge that in this current market where the home prices are really heated up and the supply is restricted, a lot of people, even with down payment assistance programs, are really finding it difficult to become homeowners because they are not competitive enough. So I do think this policy will have a longer term impact because it's better targeted, but I don't think it will have like immediate income, but in the long term, it is one of the policies that can really kind of make a change in better targeting Black and Latino households who have been discriminated in the housing market for a long time. And I don't think if we kind of do it a very clever way of not trying to like distribute money all at the same time, it wouldn't really increase the inflation pressures. So if we actually do it in a very clever way and think long term, then it can actually do a better job of targeting the people who do not have a rich uncle that can support them getting into the housing market and create a more equal society. And I do believe that I think this could also have an impact on improving the economic health and resilience of our vulnerable communities, because when the pandemic hits and when the inflation goes up, it's the renters who are hit more harder because their rent prices go up very fast But if you're a homeowner, you're actually secured in paying the amount of mortgage payment over a long period of time. So you are less volatile to the economic shock. So although there could be some preferences in accessing homeownership, if a person is disadvantaged just because they don't have a wealthy parent, we do have to fix that issue. And I do believe that the targeted down payment program is a long-term good policy. Thank you.
Thank you, Dr. Choi. Ms. Pope, in the remaining time that I have, I was struck by your testimony on this issue. You stated that rising interest rates along with rising home prices and a limited housing inventory make a perfect storm to suffocate Blacks out of the housing market. I believe you are a practitioner, so please correct me if I'm wrong there. And can you speak to this? What can we do to mitigate the effects of the current market conditions, particularly for minority households? And from your practice, from your work, what do you hear about preferences and the desire to be homeowners instead of renters?
Thank you. I'll be real quick. The down payment programs are very important for Black Americans as we try to get into home ownership. Also, we're dealing with the elimination of loan level pricing adjustments. That's been a challenge with the credit scoring because of the percentage points is pulling us out of that. Also, with the appraisals, we mentioned earlier, we are the front lines of appraisals. You know, there's been biases and there's been documentation as it pertains to the appraisals and the biases that happen within the Black industry, as well as what I like to say is the student loans. If we can bring that to a level where it's more affordable, Blacks can be able to buy a home.
That's good.
I'm out of time.
I thank you. I see my time is out, and I thank you very much. I yield back.
Thank you very much. The gentlewoman from Georgia, Ms. Williams, who is also the Vice Chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Chair Waters, for first holding this very critical conversation, as it means so much to me and my constituents in Atlanta and the rest of the nation. Because y'all, my hometown of Atlanta, unfortunately, leads the nation in the racial wealth gap. And unsurprisingly, it also leads the nation in the percentage of homes bought by investors. Y'all, home ownership is tied directly to the ability to build generational wealth. When individual homeowners are locked out of the market by investor purchases, they have fewer opportunities to buy a home and build the type of generational wealth that will help close the racial wealth gap, not only in Atlanta, but across the country. So, Dr. Choi, listening to your testimony and the conversation that you were just having with Representative Dean, I'm wondering what specific investments can we make to put individual home buyers on more equal footing with private equity investors?
Yes, that's a really great question. And I think one of the things I would like to also point out about the impact of institutional investors is that there are various research, but then in particular in Atlanta, there has been a recent research because institutional investors are so prevalent. So nationally, they might not have a large impact, but in Atlanta specifically, we do find that increase in institutional investors have affected renters and especially Black renters to access homeownership.
Unfortunately, Atlanta is also at the top of that list, Dr. Choi.
Yeah, so yeah, I think the data is really concerning. So I think we talked a lot about the down payment assistance programs. I know that some lenders and also GSEs are considering special purpose credit programs where they can direct access to some of the capital to the communities or people of color who have been previously discriminated. So I think SPCP is another good way to bridge the racial equity gap in this country. Another thing that I think is important, and I know that there is a move in this space of like thinking about including rental payment data into mortgage underwriting. One of the things that we also see from the data is that more greater share of Black and Hispanic households do not have FICO scores, and they have lower FICO scores. And if you actually include rental payment history data into mortgage underwriting, our research does show evidence that this does disproportionately help households of color. So I know that there's some movement in this space, but we also encourage more consideration of including rental payment in mortgage underwriting.
Thank you, Dr. Choi. And that is something that we're absolutely working on under the leadership of Chair Waters in this committee. I just had an amendment last week that will do just that, allow consumers to opt in to add their rental history to their credit scores. Also, during the pandemic, the percentage of home sales to first-time home buyers has been much lower than the 5-year average percentage. So, Dr. Choi, what does this mean for long-term home ownership trends and our ability going forward to address inequities in home ownership?
Yes, I think homeownership is very unique because it's kind of like a way to build long-term wealth. And what our research show is that if you actually delay purchasing your first home, you actually have lower wealth at the age of retirement. So the timing of buying your first home, the age is very important. And we know that Black households and Black people are less likely to buy homes earlier in their life. So that is one of the reasons that it's not just access to homeownership, it's the age of accessing homeownership and also sustaining homeownership. All that factors into the wealth disparities. And as we mentioned again and again in this committee, is that homeownership and wealth transfers from parent to children. So this is not just like one family issue, it actually is creating intergenerational wealth inequality. And that's a key reason that we have persistent racial disparities in this country.
Thank you so much, Dr. Choi. Increasing home ownership, especially among Black home buyers, is not guaranteed without meaningful policy intervention. So, Dr. Choi, your organization estimates that home ownership could decline by 2040, especially for people who look like me, if action is not taken. Can you explain how this projection was reached and what steps can be taken to expand government-backed loans to first-time home buyers, particularly Black borrowers?
Yes, one of the things that I also wanted to point out about this research is that this was before the pandemic, so we didn't incorporate the impact of the pandemic. And if we actually do, there is a high likelihood that the numbers would look worse over time. So we do see that every time there's an economic shock, it's actually the communities of color that's been disproportionately harmed. So the pandemic, Great Recession, all shows some evidence that when their economic situation is negative, then people of color are most impacted. We did a projection by looking at the past data. So this is a projection of like household formation and income and all those factored into access to homeownership. And then we do find that because again, homeownership,
And Dr. Choi, unfortunately, I am out of time, but I was so intrigued by your research that I will be following up with additional questions. Thank you, Madam Chair, for hosting this, and I yield back the 0 time that I have remaining.
Thank you very much. Thank you very much. I'd like to thank our distinguished witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. And with that, again, I thank you so very much, and this hearing is adjourned.